What up, what up, everybody? Let me know if you can hear me. Let me know if the music is too loud or not. Let me know, please, please, please. What's good, man? I see a lot of people in the house. Oh my goodness. Okay, Tone, ATL's own in the house. K Jones is in the house. Steven is in the house. Fernando's in the house. Ryan is in the house. Kishore, we got BFG, the guy, here to learn and share. Zach, Ash the Royale, Terry Baker, Joel, Zach. No way, we got Zamunda. Nah, Mr. Money Printer in the house himself. Steven, Anthony, Gloria, I appreciate all of you guys. Thank you so much for coming out tonight. This is going to be a fun night. All right, thank you so much. This is going to be the beginner's guide to the Strat Masterclass. This is going to be my first time doing it. So if I'm talking too fast, if I feel all riled up, it's just the anxiety that I just got, just riled up in me. Thank you all so much for being here. First and foremost, I want to make sure, is the music too loud? Let me know if the music is too loud. If it's not and you guys can hear me all right through the music, then we'll get started. Please let me know. Oh my gosh, everybody's here, man. I appreciate you guys so much for coming out. This is going to be a great evening. Okay, y'all telling me that the music is good? Okay, we'll get started then. We'll get started. Beautiful, beautiful, beautiful. Well, welcome everyone. And welcome to the first beginner's guide to the Strat Masterclass, hosted by yours truly. I appreciate all of you for taking the time out of your day, evening, morning, wherever you are in the world, to listen to me talk about this strategy. As this is on YouTube Live, this will be interactive, so feel free to use the chat. I do ask if you can save the questions till the end of the presentation so we can get through the presentation first. We're also going to be going through some trading view examples. And last but not least, thank you all for tuning in. This is going to be a fun event. Wow, the party is here. We are good. Okay. All right. So first and foremost, the Strat is a strategy created by the late Rob Smith and is a free strategy for all to use. You can find any Strat related content online for free or on YouTube. Rob intended for the Strat to be free. You should never have to pay to learn it. All right, get that out of the way. Now on to the presentation. All right, so first and foremost, I have to read the disclaimer. I am not a financial advisor. My content is for educational and entertainment purposes only and should not be taken as investment advice. AdexTrades is not a registered investment, legal, or tax advisor or a broker-dealer. Nothing in the server constitutes professional investment or financial advice. Should you need such advice, consult a licensed financial or tax advisor. Any form of investing carries a high risk to your capital. Any kind of educational tools, signals, or trading advice are not suitable for all investors, so please make sure you understand the risk involved. Past performance and any examples of testimonials cited are no indication or guarantee of anticipated future results. Individual results will vary and cannot be guaranteed. All right, so now let's get on to the strat. So first and foremost, here we're gonna have a list of topics that we're gonna be covering in the presentation. First, I'll give a little background on myself. Then we'll talk about the basics of the strat before moving on to the scenarios, then the universal truths of price action, the strat combos, price action is fractal, multiple time frame analysis, and if we have time, we will be going over part 2, which is trading the strat. All right, so a little bit about me. First, I go by Adex. I am the owner of the AdexTrades Discord server. I've been trading options for 4 years now. I'm primarily a swing trader. Majority, if not all my trades are based on technical analysis. I started my technical analysis journey with Elliott wave theory in the spring of 2020 before transitioning to the strat in the fall of 2020. Shout out to my friend Devin, who actually introduced me to the strat. I started learning about market structure concepts. Shout out to those of you that trade ICT last year in the spring. But I will proudly say I am a strat trader. When I say I'm strat certified, it's not me saying that I'm strat certified. It's me saying that I love the strat. And I hope you guys love the strat as much as I do. All right. So now on to the first part of the presentation, which is the basics. So what is the strat? So the strat is a price action trading strategy that was developed by the late Rob Smith. First, I want to say rest in peace to him. My condolences are with his friends, family, and to the rest of the strat family. If it wasn't for him providing this gift to this trading community, a lot of us either wouldn't be as successful as we are today or be able to understand price action the way it is today. So I just want to give my condolences. After more than 20 years of looking at charts, working as a trader at the Chicago Stock Exchange, Rob noticed that there were certain patterns or specificities when it comes to the way that price moves. He said that their price can only move in three ways, which he described in the three scenarios. Now, one reason why straters love this method so much is because it eliminates market noise and focuses on what we can only see, which is price action. And those elements of price action, which we describe in the scenarios, are the scenario 1, inside bar, scenario 2, directional candle, scenario 3, the outside candle. So when we say that the strat eliminates market noise and only focuses on price action, this excludes all subjectivity. And I want everyone to write this down, that the strat is not subjective. It is objective in nature. And that is why we love the strat. According to Rob, he has a saying that he says that what we see is what we know to be true. So what we see at that current moment is exactly what we know. We don't guess, we act, all right? And the strat works by analyzing charts on multiple time frames, and it describes the universal truths of price action. Now, before we discuss price action, we need to talk about the candlestick. So let's talk about that first. So what is the candlestick? So the candlestick is a visual representation of the price movement of an asset. Candlesticks have various sizes, shapes, and colors, and each bar or candle represents a specific time period. Now, why is this important? Well, the shape of the candlestick is used to infer price momentum and make predictions about future price movements. It is literally the fundamental element to price action in itself. So a lot of people will hear me in the Discord talking about, oh my God, look at the candle, look at the candle. When I talk about that, the reason why is because it's literally the basis of price action, and we'll talk about that. So when we talk about the candlestick, strength or buying is represented by a bullish or a green candle. So my apologies for those of you that know, I use yellow as green and I use white as red. Those are just the colors that I like to use. Shout out to TradingView, they allow you to do that, right? So, but strength is represented by green and weakness is represented by a red candle. And the anatomy of the candle consists of 4 distinct values, which consist of the open, the close, the high, and the low. So in between the open and the close is the body, and that represents the range between the session's opening and the closing, and the closing price. When the candle closes green, this means that the close of the session right here, this means that the close of the session was higher than the open. Okay, so I want you guys to write down. If you guys see a green candle, what does that mean? It means that the close or current price is higher than the open. If the body closes red, it means that the close of the session was lower than the open. All right. So what constitutes to a red candle? It means that the close of the session was lower than the open. The thin vertical lines above and below the body are called the wicks or the shadows, which represent the shadows price extremes or the high and low prices of the trading session. All right. Let's go for a review. All right, I told you guys this is gonna be interactive, so I'm gonna need your guys' help here. Now, what determines a green candle from a red candle? What is the difference between a green candle from a red candle? Somebody let me know in the chat. Let me know in the chat. What determines or what is the difference between a green candle from a red candle? I know some of y'all in here. Let me see. Let me know. Let me know. Get the chat going. Let's see. Let's see. Bullish. Okay. Someone said bull Shipper Pop said bullet the closing price. Okay. All right. Strength and weakness. The close. Green strong. Okay. Ryan, you got it. Stock market baby, you got it. Johnny, you got it. Okay, y'all coming up with the okay, open and close. Correct. Okay, you guys are following along. I like to see that. Y'all are paying attention. Okay, you guys came to the right place. I told you we're gonna have a party today. Keep it going. Thank you. Okay, you guys are correct. The open and the close. Because sometimes people forget, oh, are we red or are we green? I keep saying, where's price? Remember, the fundamental basis about everything today, we're going to be talking about price. Okay, so you guys are getting all the answers correct. You guys are correct. So what makes a green candle is that the close is above the open. And what constitutes a red candle is that the close is below the open. Okay, so we got that right so far. So let's go on to the next part of the presentation, which is the strat scenarios. Okay, so what are the strat scenarios? So when we talk about price movement or price action, we describe it in three scenarios. Scenario one, which we call the inside bar, which represents consolidation. We have scenario two, the directional candle, which represents direction or one side of the range getting taken out. And scenario three, which is the outside bar, which represents scenario where price takes out both sides of the previous range. But first, let's talk about scenario one. So scenario one, or the inside bar, is a lower high and a higher low compared to the previous range. Okay? It is a bar that is not strong enough to take out the previous high or the previous low, which constitutes or in turn represents consolidation or equilibrium. So if you guys look at this candle right here, remember green in this case would be yellow and red would be red. In this bar right here, we see that the high of this candle is not high enough to break the previous candle's high. You also see that the low of this candle is not low enough to break the previous candle's low. So this means that this candle, in comparison or in contrast, however you want to look at it, in comparison to this candle, is in equilibrium or consolidation. And this is important when you want to determine who's in control between buyers and sellers, because right now it is in equilibrium. Okay, so if the current candle is live and inside, so let's say you're trading today. You're looking at the daily chart, you have your you have your technical indicator that gives you the 1, 2, and 3 candles, and you see that the current daily chart is an inside bar. We would call that inside bar today, we would say that that current candle is live and currently presently inside. So we would say that that live candle is currently or presently inside. Because remember, the reason why we're saying currently or presently, one, we play what we know to be true. So we're talking about what we know right at that moment. If someone were to ask you, what is price doing right now? You would tell them we are currently or presently inside. And the reason why we would say that is because remember that candle is live and still has the ability to become a 2 candle. And we're going to talk about 2 candles in the future slide. But that's why we say that it's currently or presently inside, because price is still, the day is still going on. Price could still move up today. Who saw what SPY did today? Shout out to those of you that traded today. Y'all saw SPY go crazy, hit 2 up on a day, and it was out of here. So it went from inside, currently inside, to now a 2 candle. We'll talk about a 2 candle. Do you guys understand me so far? Are we understanding the difference between a currently and presently inside candle and a candle that closes that's in equilibrium? Do you guys understand me so far? Let me get some yeses. Let me see some no's before we continue. I want to make sure y'all with me. Remember, we are class is in session tonight. Are y'all with me? Let me make sure. Let's see. Yes. Okay, here to learn, share. Thank you. Perfect. Yes, good. Okay, all right. So we got that. So remember, if the candle closes after 4 p.m. Eastern, we will look at the candle, and if it's inside, we will say that candle is currently at equilibrium. Now, let's talk about scenario 2, which is the continuation or the directional bar. I hope y'all didn't forget about scenario 1 yet. Hope y'all didn't forget about scenario 1 yet. All right, scenario 2, let's go on. So scenario 2 represents direction or a trending move. For scenario 2, price takes out one side of the previous range, which is why we call it a directional candle. It does not take out both. It only takes out one. It only takes out the high or the low of the previous candle, okay? If the candle breaks the high, in this case right here, we see this candle and we see that compared to the previous candle, it is breaking the top side or the high of the previous candle. So if this candle breaks the high and it does not break the low of the candle, we would call this candle a 2-up candle. All right. And the reason why we call it a 2-up candle is because it creates a higher high and a higher low compared to the previous candle. So, and this by definition is an uptrend. I want people to write this down, that if you see a 2-up candle, this creates a higher high and a higher low compared to the previous candle, and that by definition is an uptrend. Now, let's look at a directional candle that breaks only the low of the previous range. Now, this candle right here, and the reason why I specifically have this candle, even though someone would say like, wait, but it didn't break the low of it. Yes, it did. Because remember, everything is in relation to price, right? Let's just say that price right here is at $100. And we know when this candle right here is definitely at a lower price compared to this candle. That by definition makes this a 2-down candle. And what makes it a 2-down candle is that it creates a lower high and a lower low compared to the previous candle. And that by definition is a downtrend. So this now answers the question of, does the candle color matter? How many stratters and how many times have you guys heard like, oh, does the candle color matter? I see a hammer, but it's red, right? The reason why we talk about the candle colors irrespective is because of the fact that by definition, the candle created a higher high and a higher low. So sometimes you guys have heard me, whoever's in the Discord, I'll say that price went up. If let's say something triggers, how many of you guys trade the strat, right? And it triggers 2 up on the day and then it pulls back. But y'all know me, I'm going to be staying in that play even though it pulls back. And why? Even though it's red, or let's say our option call is now red, I'll say price went up. It made a higher high. So by definition, we are in an uptrend. And we know that we're going to talk about invalidation later, unless we invalidate and now create a lower low, that higher high is intact until proven otherwise. But we'll talk about that later, right? So regardless of the candle, if it's red or green, if it's a 2-down candle, you created a lower high and a lower low compared to the previous candle. And if the opposite is the same, if price went up. If price went up, it went up. On to the next slide. So here's another example. 2-up candle right here. Price made a higher high and a higher low compared to this candle. And you have a 2-down candle right here. Actually, 2 2-down candles. This is a lower low and a lower high compared to this candle. Now, I want people to pay attention to these 2 candles right here, because I have this example specifically because some people will say, wait, but they look pretty equal. Now, the importance about the strat is that price needs to, not the strat, the 2 candle is that price needs to break one side. So when we talk about breaking one side, we literally mean by the cent. So if this price right here is at $100.20, this candle literally needs to go to $100.21 to break the high of this candle to now make this a 3. But we'll talk about 3s in a later slide. But in order for this to actually go higher, this needs to literally be a cent more to actually be a 2-up. But in this case, it would be a 3. All right. Hope that makes sense so far. Hey, I see Michael, stupid 2-up, 2-down fake outs. Hey, I know what you're talking about. Don't worry, we're gonna talk about that in a later slide. I know a lot of stratters know about that situation. So Now let's talk about the outside bar. And this is the last strat scenario. I hope no one forgot about the inside bar so far. No one forgot that it represented consolidation. I hope no one forgot that the continuation represented the direction. Now let's talk about the outside bar. So the outside bar, or the scenario 3, is when price establishes a higher high and a lower low compared to the previous range. This right here is a scenario 3. And the reason why it's a scenario 3 is because you can see in relation, or in comparison to the previous candle, it breaks the high and it also breaks the low. Okay. Now, this is one of the most important elements of price action, the scenario 3. And I think it is very important for every trader to understand. Me personally, I feel that once you understand the phenomenon about the outside bar, it saves your portfolio. And what I mean by that is that once you know a 3 exists, you will no longer question why trades go against you. Because you know if you created a scenario 3, you know if price invalidated or not. Rob has a saying, and he says, once a 3, always a 3 cannot be. And it's important to note that a scenario 3 cannot occur without becoming a scenario 2 first. I'm going to say that again. A scenario 3 cannot occur without becoming a scenario 2 first. So an outside bar does not happen without first being a 2. Let me show you why. So let's look at this example right here. Let's look at this chart to the left. So we see that in this example, if you look at this candlestick right here, we see, remember, white represents red. My apologies for those of you that are new, but white represents red. We see that price literally gaps up and opens higher than the previous high. By definition, we know that since price gapped up and opened higher than the previous high, it should constitute as a 2 up candle, or it made a higher high. By definition, it's an uptrend. But what happens throughout the day? Let's say if this was a daily candle. If you see that price immediately, once we open, we kind of wick up a little bit, but then it immediately starts selling off. And not only does it just sell off, it sells off so much where now we not only go and we're back at the previous range's high, where we go down to the previous range's 50%, we go all the way down to hit the previous day's low. So remember, y'all, we were originally, price was at a high to where it was at a higher high compared to the previous high. And by definition, that is an uptrend. Someone would say bullish, right? But then price comes down, and it doesn't just come down. It comes down all the way down to break the previous candle's low. It went from a 2 up candle to going down 3. And I'm going to be, don't worry, we'll show you in a trading view example and things like that. Look at this example right here. In this same example, you see that price opens up here because by definition, this is a red candle. So we know that the closing price is lower than the opening price. So we open right here, we open inside, price goes up, wicks up to become a 2 up candle before price coming down to become a 3 candle to the downside. All right. So safe to say most candles are 2. Yes, Jeff, you are correct. Most candles are 2, and we will see in the trading view. And that's also why, for those of you that see in my trading view, I don't have the 2s up, because if we know that most candles are 2s, then it would also help with just understanding the 1s and the 3s. But we'll talk about that. So now, why is the 3 bar important? You guys have seen that the 3 bar takes out both sides of the previous range. Okay, who cares, ADEX? It takes out both sides of the previous range. What else? Well, that leads us to our next topic, which is the universal truths of price action. So let me make sure y'all with me so far. Y'all good? Let's do a little bit review. Before we talk about the universal truths about price action, we talked about the 3 scenarios. Let's see if we can do a little quiz real quick. What is a scenario 1? Let me know in the chat. What is a scenario 1? What does a scenario 1 represent? Let me know in the chat. Let's see. Let's see who got the sticky fingers. Okay, Nori got the sticky fingers so far. Inside bar, appreciate you. Let's see what else. Anybody else? What does the inside, the scenario 1 represent? What does inside mean though? Equilibrium if closed, okay. Inside bar, okay. Inside bar, inside or consolidation, all right, okay, cool. Good, beautiful, y'all got it. Like, you saw y'all paying attention. Okay, now, what does the directional candle mean? What does the directional candle mean? Please let me know. What does the directional candle mean? Let's see if you guys are paying attention. No one's paying. Let's see if y'all not sleeping yet. I know East Coast is getting up there about 8:26 p.m. I know I hope it's not some people's bedtime. Hope we still here. Hey, Vincent here. I see you. Hey, Inside Bar Bandit. I like that. Hey, you clever with that one. I see you. Nice. I like it. Okay. Good. All right. Direction. Twos. And I apologize, y'all. The live chat, there's like a little delay, like a little 10-second delay. So if you guys see me talking about the previous thing I talked about, that's the reason why. Okay. Price either goes up or goes down. Cool. Okay. Good. I like it. Price breaks one side, broke higher than low. Okay, you guys are getting it. We back in school. Now, last but not least, what is the outside bar? What does the outside bar represent? And then we'll go on to the universal truths of price action. What does the outside bar represent? Let me know. Good. Ooh, Tone said accumulation and distribution. Hey, you trying to get fancy with it. I see you. Okay. All right. Not there yet. We ain't there yet. I see. I love it. Good. 3 represents price expansion. Yes. Breaks both sides. Yes. Price takes both sides out. You guys are getting it. Good. A trick 2 that reverse. Yes, I like that. Trick 2 that reverse. Takes out both sides. Ooh, someone said aggression. Oh, I like that. Okay. Good. You guys are getting it. Perfect. All right. Appreciate you guys paying attention. Now, let's go on to part 3, which is the universal truths about price action. Now, there are 3 universal truths when it comes to price action. And before we talk about the first one, you guys remember how I talked about how the outside bar is one of the most important elements of price action, right? Well, let me get into more detail. So the reason why the outside bar is important is because the outside bar is a broadening formation on a lower time frame. And a broadening formation is one of the universal truths of price action. So what are broadening formations, ADEX? Well, broadening formations are a series of higher highs and lower lows. It is how price is discovered. And we know that price moves in terms of aggregation, and it moves in a series of higher highs and lower lows. So if you look at this example right here, you see this outside bar. So the 3 candle, and this is a scenario 3. And a scenario 3 is a broadening formation on a lower time frame. So this chart right here, this is the monthly chart, and the right chart is the 4-hour time frame. Now, obviously, because of the charting software, whatever charting software you have, wherever you place your lines, if you're trying to, use the magnet tool, price may not literally touch the broadening formation to the literal point, but at least you get what I mean when we talk about like support and resistances of the broadening formation. So this right here is this 3 on a lower time frame. But you guys are going to see. Let's talk about it. Let's continue to talk about it. So you'll see that in the area highlighted, this is in fact that broadening formation on a lower time frame. This area highlighted is that 3. So there's your broadening formation. Since the 3 is a broadening formation, as straters, we know that price broadens over time. I want people to write this down, that since the 3 is a broadening formation, we know that price broadens over time. And I'm gonna be honest with you, like that's kind of why like some like OG straters like they laugh at people who use horizontal lines and stuff, because like they understand, and of course shout out to Rob, he understands like price broadens there's price doesn't stop at like a horizontal line and all of a sudden just come down and come back up. We'll talk about that later in terms of wicks. I know people will say like, wait, hold up. We'll get there. But because of the fact that we know that price broadens over time, that is one of the universal truths about price action. Let me give you an example of Nvidia. Nvidia hit all-time highs, right? Over time, it broadened. Shout out to what am I talking about? Shout out to the homie Sal, Mr. Nvidia himself. Last year, when Nvidia hit all-time highs, what did Nvidia do today, or was it yesterday? All-time highs again. Over time, in a year, price broadened. So it didn't just hit the high that it did back in, what was it, February or March when it hit back in ER. It didn't hit that high and then all of a sudden come down. No, it went higher. That's why we talk about broadening formations are very powerful. Okay, so the strat accounts for time. Horizontal lines do not. Now, how to draw broadening formations. Once you're able to identify highs and lows, you draw back from the current high to the previous high, and you draw from the current low, and I'm sorry, I know this is the current low, but let's just say in this case, right? The current low to the previous low. And you'll know that it's a high because price action will reverse and go to create a new low. Or not a new low, but it'll create a low. And you'll know that it's a low because price action will reverse to create a high. So if you were to look at a chart from left to right, let's all get our hands and go left to right, right? You will see that the high needs to be connected to a higher high, going to the right to a higher high. If you looking from the left to the right, the low needs to be connected to a lower low. So in this example, left to right, you see that high connected to a higher high, low connected to a lower low. Okay, it is not going to be low connected to a higher low. That is not a broadening formation. And the reason why I have this specifically in my chart, because a lot of people ask, and I know a lot of people will continue to ask, how to draw broadening formations, and did I draw broadening formations correctly? Broadening formations, it may seem like, oh, that's pretty simple. No, it's actually, it could take some time to learn, right? Broadening formations, you need to understand that if you were to look at a chart from left to right, it would be that the low is connected to a lower low, and it would be that the high is connected to a higher high. So in this case right here, looking from left to right, you see that a low is connected to a higher low. Therefore, this is not a broadening formation, okay? This is a broadening formation. Hope that makes sense. Does that make sense? I want to make sure before we move on, that part makes sense, because I know a lot of people are going to have questions on that, and I know that has been a question, and remember, we in class today. We are learning. So does that make sense? Why did we skip that 2-up candle when drawing the broadening formation? Please, Nori, keep that question in mind. I do not want you to forget that question, because we will answer that towards the end of the presentation. Okay? Cool, we all making sense? All right, cool. Perfect. Peter, keep that question, please. Keep those questions, because we will answer them. All right, perfect. Let's go on. Let's move on. So, actually, my bad. So now, why are outside bars important? Okay. Another reason, we talked about how outside bars are broadening formation on the lower time frame. Now, another reason why outside bars are important is because it helps us gauge magnitude. Now, magnitude refers to the opposite side of the range. Or for those of you that are in the Discord, you guys have heard me say how far price can go, okay? So now, although broadening formations help gauge magnitude, what allows price to get to magnitude is dependent on multiple factors. And that's dependent on index, sector, ETF strength, fundamental catalysts, the place within the broadening formation, and combinations, which I also like to call trigger machine gun, and time frame continuity. Now, notice how I have combinations, and time frame continuity highlighted. As straters, these are important factors that help us identify if price will get to magnitude. But before we talk about combinations, we first need to talk about participation groups. So participation groups are representations of different time frame charts. And I have an analogy for this. I'm not sure if this analogy has been used before, but this is something that it makes the most sense to me, and I just get it. But I want you guys to think of it as the legs of a relay race, okay? So think of it as the legs of a relay race. The different participation groups are different time frame charts. The daily chart, or the daily time frame, represents daily participants, or participants who added, entered, or reduced a position that day. The weekly chart represents weekly participants, participants who added or entered, added, or reduced a position that week. The monthly chart represents monthly participants, participants who added, entered, or reduced a position during that calendar month. And the reason why we use the different participation groups is because they're used to quantify full time frame continuity, and is the reason why we look at more than 4 charts at once. Okay, so for those of you, you've been on Twitter and you're like, oh, why is there 4 charts? Like, they're probably a stratter, or they're probably someone that uses multiple time frame analysis. And the reason why is because by extrapolating with more data, by using more charts, you can get a better visualization of where price can possibly go. Okay, and not only that, it's when you're trading, and we'll talk about trading the strat later on, but when you're trading, it's very, very, very important to understand which participant you are, okay? Because we'll talk about it later, but you need to understand which participant you are. And the reason why, because I want you to think of this like this. Now here's NVIDIA on the daily time frame. And actually, this is today. I updated it because NVIDIA's breakout was so beautiful. I was like, oh, I gotta do it. So like, this is NVIDIA on the daily time frame. If you guys were to look, this is a question for you guys. Based on this current candle, like if you were to look at the current candle, the rightmost candle, right? And if you guys understand this indicator, act like you don't see it. But based on this current candle, which participant would you say is in this trade, or what we say aggressive, or is the aggressor? Buyers or sellers? Let me hear what you get. What do you guys think? Buyers or sellers? If you were to look at this candle, would you say is buyers or sellers that are in this today? Ryan said it was straight fantastical. Yes, it was. Dude, I don't even want to. That the video is phenomenal. What would you guys say? Who is in this trade? Buyers or sellers? Buyers. Oh, okay, we got buyers coming out. Oh, the buyers coming in hot. Okay, y'all understand immediately. Okay, you guys know the difference between buyers and sellers. I like it. Okay, so based off the daily, remember this is a daily chart. You guys are saying that buyers are in this trade. You guys are correct. Buyers. Now, let's look at the weekly time frame. Here's NVIDIA on the weekly time frame. Based on this current candle, who would you say is in this trade? Buyers or sellers? On a weekly time frame. This is no longer a daily participant. These are the weekly participants. Buyers, baby. Oh, yeah, buyers, bulls in control. Yes, they are. Yes, they are. We'll see what happens tomorrow with CPI, but yes, they are. Okay, good. You guys get it. So buyers are on the weekly time frame. Buyers are aggressive on the weekly time frame. If you were to look at the monthly time frame, if you're NVIDIA, who would you say is in this trade? I'm just gonna make it obvious for you. Buyers, okay? And then last but not least, if you were to look at the quarterly time frame, who would you say is in this trade, or who is aggressive? Buyers, okay? So these are the different participation groups in this trade. And now if you put it all together, I want you to think of these different time periods as the participants of a relay race, okay? Or the legs of a relay race. The daily participant has the ability to hand the baton to the weekly participant, The weekly participant has the ability to hand the baton to the monthly participant. The monthly participant has the ability to hand the baton to the quarterly participant. Now, I know some of you are probably listening like, what is he talking about? Well, don't worry, I'll get into more detail. But when we talk about these different participation groups, you want to understand who's in the trade. And that's why, and some of you that are in the Discord, and when we ask like, is prices coming down and we're in calls, and I'll say like, look at the daily. And I'll ask like, what time frame are you looking at? And they'll be like 15 minute, 30 minute. I'll say, look at the daily. Who's in the trade? And they'll be like, buyers. No, look at the weekly. Who's in the trade? Buyers. No, look at the monthly. Who's in the trade? Buyers. I'm like, so should you be buying or selling? I should be buying. Okay, there's your answer. It really, and I don't want to. It's not. I don't want to say, oh, is that simple? No, it's not that simple. But it actually gives you a statistical analysis, or it helps you understand who's in control. And once you start understanding the different the legs of the relay race, this leads to combinations. Okay, so combinations increase probability by having separate participation groups trigger others. Stratters should always, and I mean always, because like at the same time, we'll talk about this later about how we should be making money. We'll talk about that later, but we should always be looking for combinations of actionable setups, okay? And this leads to like a phenomenon when we talk about the trigger machine gun, which I'll talk about later, because when one participation group triggers another, it moves in force, it reconfirms the actionable signal, okay? I want you to think of it, remember, I talked about the legs of the relay race. When one participation group triggers another and it moves in force, it reconfirms the actionable signal. Now, you know what's funny? I was giving this example. I was telling this metaphor, this analogy to my little sister, and she was like, I still don't get what you mean. And I was like, okay, let me try to break it down for you. So let's say you have a relay race, right? We know that there's a probability of a team finishing that relay race. And we know that based on probability analysis, we know that, let's say the baton is handed to the fourth leg, the probability of that person or the team completing the relay race is higher compared to when the first person or the first leg had the baton. Wait, Adex, what are you talking about? Let's just think about it, okay? If the fourth leg has the baton, they are literally at the fourth or the final leg of the race. If the first leg has the baton, they're at the first quarter of the race. So they're literally in the first 25%, while the last leg is in the last 75%. Just based off statistics, the last leg or the final leg of the relay race has a higher statistic of finishing the race. Do you guys get that? Or did I just give you guys oh my God, now he just went to the left. Let me make sure y'all understanding so far. I want y'all to understand combinations, the relay race, different participation groups. Do we understand so far? Let me make sure you all still with me. We good. Good. Let me see. Like I said, sorry, there's a little bit delay. I want to make sure y'all still here. Say that again? Yes, okay. Yes, I'll definitely say it again. Okay, so I want you to think of the different participation groups as the different legs of a relay race, okay? Think of the daily being the first leg, the weekly being the second leg, the monthly being the third leg, and the quarterly being the fourth leg. Those different participation groups, okay? Now, if you think of it based off statistical probability, what is the probability that this team completes or finishes the race? We know that if you were to look at the race and you see that the baton is with the fourth leg, we know that there is a higher probability of finishing the race because they're at the last leg of the race. Does that make sense? compared to when the baton is in the first leg of the race. There is a lower probability compared to the final leg based off the fact that we know the first leg is in the first quarter of the race compared to the final leg. Does that make sense? Yes, DJ, it sounds like getting gradual horsepower. Yes, horsepower, good. Okay, I hope that teamwork makes the dream work. Yes, teamwork makes the dream work. Daily participants handing the baton to the weekly participants. Yes, and don't worry, I'm going to show you guys trading view examples too. Don't worry, I'll show you guys trading view examples. Okay, beautiful. All right, so what that does is that reconfirms the actionable signal. Now, why do participation groups matter? That leads us to our next universal truth of price action, which is time frame continuity. Okay, so time frame continuity is used to identify periods of control or periods of conflict between buyers and sellers. Traders who trade in time frame continuity try to take advantage of the particular side being present during that moment in order to achieve maximum profitability. Our goal is to identify who is actively in control in the given market, whether that be buyers or sellers at whatever time frame. So for those of you that know the trading view indicator, shout out to Board Rider B for this one right here, and shout out to Nagami for the Strat B2. You guys will see that based off time frame continuity, we know that the day is green, the week is green, the month is green, the quarter is green, the year is green. In this example, the day is red, the week is red, the month is red, the quarter is red, and the year is red. Don't worry, I'll show you an example. Ideally with the strat, we want to identify and trade stocks that are moving in the same direction in all time frames. In other words, the best opportunities tend to lie in stocks that are trading in the same direction on the daily, the weekly, the monthly, the quarterly candlesticks. And if a stock is trading in alignment with these principles, we consider that stock to be trading in full time frame continuity to the upside. Buyers are literally in control of this stock, and we should only be looking for opportunities to go long. And just like for the opposite side, full time frame continuity to the downside is when a stock is trading below the opening price of the current daily, weekly, monthly, and quarterly time frame. Let me show you some examples. So this is an example. And for the contrast of you guys, I made sure that I had green and red candle just so you guys can actually see what full time frame continuity looks like. So MU, this is MU. You can see that the daily chart is green. The weekly chart, green. Monthly chart, green. Quarterly chart, green, right? So therefore, we are trading in full time frame continuity to the upside, or what we like to call bullish full time frame continuity. Bullish full time frame continuity is defined as the last sale being higher than the open of the daily, weekly, monthly, quarterly, and even hourly candles. So I hope we all understand this. Remember, let's relate it back to the candlestick. Remember, relating it back to the candlestick, we understand that the bullish candle or a green candle means that the open is higher than the close. I'm sorry. No. That the close is higher than the open. For a green candle, the close is higher than the open. I don't want to get y'all confused. Close is higher than the open. And remember, for a red candle, we know that the close is lower than the open. Let's talk about a bearish time frame continuity. So this right here, we have Twitter, full time frame continuity to the downside. Bearish full time frame continuity is defined as the last sale being lower than the open of the daily, weekly, monthly, quarterly time frame. Okay, so in this case, when you see a stock that is trading in full time frame continuity to the downside, I will only be looking to enter puts since we have full time frame continuity to the downside, because we know that sellers are currently present. Does that make sense so far? And we're not going to talk about broadening formations, reversals. I don't want anybody get too intricate here. Not yet. Remember the basics. That way it didn't hit a I know people are gonna be, well, it looks like it's gonna hit a broadening. No, not yet. Do we understand so far? If we're trading in full time frame continuity to the downside, we would want to be a seller for that trade or for that stock. Does that make sense? Let me make sure. Hey, Glaza said I'm used to the yellow and white now. That's so funny. Love green and red. Thanks. Oh, you're welcome. You're welcome. And the strat, we have the Strat V2. Shout out to Nagami. He was the one who created the Strat V2. You also have the Strat Assistant. There's multiple. Actually, I want to say shout out to every single one of you that have been instrumental in creating resources, creating indicators for the Strat community. We appreciate every single one of you helping one another. We appreciate, even if it's paid, we don't care, because you put time and work to be able to help. And so we appreciate all of you. So, okay, we good? We all get bearish full time frame continuity. Good, I'm glad. All right, so now, time frame, when we talk about time frame continuity tells us the level of aggression between buyers and sellers. So when we are in full time frame continuity, the aggression of buyers or sellers, if we're full time frame continuity to the upside, aggression is buyers, or full time frame continuity to the downside, sellers, right, is high. And this cannot be disputed. So, and it's one of the universal truths of price action, okay? I want people to understand that when we are in full time frame continuity, you know what is going on at that current moment. Do not fight it. If it's red, if it's green on the day, green on the week, green on the month, green on the quarter, green on the year, you know who's there. What we love about the strat is that it's empirical in its nature. You know it's there. It's not no ifs, ands, or buts. Look at the chart, okay? It cannot be disputed, okay? Now, how do you know who is in control at that present moment? I know, oh, well, look at you just said, look at the chart. Well, how can we empirically know that? Well, that is determined by the opening price, or what I like to call the flip. Now, the flip, for those of you, the OG stratters, and for those of you that learned the strat and who had Rob has taught it, this is different from the flip that happens at the bottom of the hour. So this is just how I just call this the flip. And I apologize if now people get confused, but I like to call the opening price the flip, because I like to say when we flip the candle, when does the candle flip green? When does the candle flip red, right? So the opening price, or the flip of the candle, determines which participation group is in control. We know that when price breaks the high or breaks above the open, the candle is green. When price breaks below the open, the candle turns red. So it's seen as a candle color change, a flip from red to green, flip from green to red, when prices crosses the opening of the candle. And the flip will either confirm if the higher participation groups are in conflict or in continuity, okay? Now, when we have time frames that are different than the other, we call this conflict in continuity. And this is when time frame participants are disagreeing with each other. So if you see that the day is red, but the week is green, the month is green, the quarter is green, you have a conflict in continuity. The daily is in conflict with the weekly, the monthly, the quarterly participants. And that, just if you actually talk it out, sometimes that even helps you with what participant you should be. If I say, the hourly is in conflict with the daily that's green, but in the week is green, the month is green, the year is green, but it's only the hour that's red. If you are a swing trader or a higher time frame participant, you would know that the higher time frame participants are green, right? So how far away price is from the flip also establishes control. When we know that price is near the flip or near the opening price, we know that price is near equilibrium and there's a balance between buyers and sellers, right? So for those of you that seen what a doji candle looks like, we know that the open and the close, or price is relatively near each other or relatively near the open, we know that there's a equilibrium between buyers and sellers. But when price is farther away from the open, we know that one side is aggressive. And I'll show you guys that in TradingView. Does this make sense so far? I want to make sure people understand the flip and the opening price of the candle. This is very important, especially when trading, because this helps you determine whether or not you should be, what side you should be on. Because you guys know me, there's been a lot of times if the day is red, but the week is green, the month is green, the quarter is green, the year is green, you guys know what side I'm gonna be on if I'm a swing trader, right? Because we know that the higher time frame participants are buying. Cool, perfect. Oh, everybody understands. Thank you. John Doe, will this live be saved? Yes, it will. Yes, it will, sir. I will make sure that I have this live recorded for you all. Appreciate all of you guys for being here still with me. We got 242 viewers right now. Give it up for you guys yourselves. I appreciate all you guys spending some time. Thank you. Good. All right. Now, let's go on to the next slide. So the next topic, uncoupling. Now, uncoupling is very, very important, okay? So uncoupling refers to the first time during any month where the opening prices of the four major time frames occur at different times. On Monday, the daily and the weekly opening prices are the same. During the first hour on Tuesday, the opening prices of the hourly and the daily are the same. Now, people are going to be like, oh my God, what just happened? I don't know what you're talking about. Let me explain, okay? So when we open on Monday, and let's say price goes up, we know one thing. If price goes up compared relative to the open, we know that the candle is green. Two things are for sure, or well, more than two things, but I'm just going to talk about the daily and the weekly participants. We know that Monday, the day is green. And we also know that if we were to look at the weekly candle on Monday, and if you were to look at the weekly candle, it would be green as well. Why would the weekly candle be green on Monday? Because only Monday has elapsed, right? So that is why the daily would be the same candle for the weekly on Monday, because it's the same day. Only that Monday has elapsed for that week. So the daily and the weekly have not uncoupled with each other. Now, let's talk about Tuesday, because we say the earliest uncoupling event is the second hour on Tuesday. But let me talk about it in terms of the daily and the weekly participants. Now, why do we say that the day uncouples with the weekly on Tuesday? Because I want you to think of it like this. Let's say price goes up. You were to look at the candle, and don't worry, I'll show you some trading view examples. So let's say price moves up $10 on Monday, right? We know that the candle is green on Monday because price moved up $10. On Tuesday, let's say the price of any stock were to drop $3 on Tuesday. So now the total gain or the net gain for that stock is a $7 gain. If you were to look at the daily candle on Tuesday with that $3 drop, that candle would be red. But if you were to look at the weekly candle on a Tuesday, that candle would still be green. Does that make sense? So the daily uncoupled with the weekly, because now you have a red day, but the weekly candle is still green. So now you have a difference, and the difference in candles, and allows you to gain more quantitative evidence on what is going on with the trade. Does that make sense so far? Does uncoupling make sense? I don't want to get y'all confused. Does it make sense? Let me make sure you guys are still with me. Don't worry, Lineage, it will be recorded. Do you guys understand uncoupling? That in order for the day does not uncouple until Tuesday, because the week will still be the same on Monday. And that is also the same if you were to compare the weekly and the monthly candle. The weekly doesn't uncouple from the monthly candle until the second week. Because let's say if you were to look at a monthly candle during the first week of January, right? The monthly candle you only have 1 week of data, and that 1 week of data happens to be the first week of the month. So whatever the first week of the month is, that's what the monthly candle is going to look like. It's not until the second week, let's say the second week is now red, but if you were to look at the monthly time frame, it's still green because it's still higher than the open. Good. Can you show an example? Yes, don't worry, Ryan. I will definitely, I will show an example. Actually, did we show an example right now? Let's see what we can do. I can probably do that for you. Let's see what candle gave a rev strat today. What is currently down on the day today? Oh, boom. Actually, let me, just in the interest of time, please don't forget that question, because I have to find the candle for you. But just in the interest of time, don't forget that question, please, because I will definitely talk about uncoupling. Okay. Does it mean that we short on Tuesday? So turnaround Tuesday. So turnaround Tuesday is another phenomenon that occurs in price action. But I'd like to say, after watching price and things like that, it doesn't necessarily mean to short on Tuesday. And I'll give you guys an example. All right. So far it seems like we understand uncoupling, and don't worry, I'll show you in the trading view example. Okay. So now onto the last universal truth of price action, which is actionable signals. Okay. So we talked about broadening formation. We talked about how broadening formations are scenario 3s on a lower time frame, or scenario 3s create broadening formations on a lower time frame. We talked about how they create a series of higher highs and lower lows. It's how price is discovered, and that is why straters don't really like to use horizontal lines, because we know that when price moves, broadening formations account for time. We talked about time frame continuity. We talked about how time frame continuity allows us to know who is in control at that current moment, and it allows us to trade in alignment with those people, or buyers and sellers, whoever's in the trade. It also leads to the highest probability of trades in our favor. Last but not least, actionable signals. So actionable signals do two things. First, they quantify specific technical conditions. It is one of the reasons, or one of the ways, straters are able to talk to each other, because we are able to quantify specific conditions, and we have a 2-1 setup. We know what's about to happen. Second, they allow us to identify market participants during price movement. Okay? Actionable signals are the reasons why you enter a trade. I want you guys to write that down. Actionable signals are the reasons why you enter a trade. So you know the beauty, one of the beauties about the strat is that every single time we take a trade, we have a reason to enter the trade. That's one of the beauties of it, and why we say it's objective in the nature. What are the actionable signals? The actionable signals include the inside bar breakout, or the inside bar or the inside bar breakout, the hammer, the Momo hammer, the shooter, the Momo shooter, and the ref strat. Okay, but first, let's talk about the inside bar breakout, or the inside bar. So the first actionable signal is the inside bar. The inside bar is defined as any bar whose range is equal to or less than the previous range. You guys already know that. And you guys already know that the inside bar is a universal truth because price is at an equilibrium. Inside bars represent consolidation, and as straters, we look for inside bars because we want to take the break of the inside bar. Now, why? This universal truth of the inside bar can't be disputed. The reason why straters take the break of the inside bar is because we know that price is attempting to break equilibrium. And as traders, we want to be on the side that is attempting to be broken. One thing that's important about inside bars or about price action in general is that we know that price action goes from a state of consolidation to a state of expansion. And as option traders, or just traders in general, we want to trade in alignment with either buyers or sellers, whoever that may be. So if price goes from a form of consolidation or a state of consolidation to a state of expansion, and we know that the state of consolidation is also equilibrium, and we know that price goes from equilibrium to expansion, this is the universal truth about the inside bar, because we know when price breaks one side of the inside bar, it is breaking that state of equilibrium. Ain't no ifs, ands, or buts about it. It is attempting to break the state of equilibrium. You see it there on a chart. You see an inside bar and you see price breaking it up. That's what's going on at that moment. Okay. So it is important to know that trading the inside bar itself is kind of dangerous. Okay. You never want to trade, and I know now later on we'll talk about it, because I know some people like, hold up, wait a minute, let's talk about the basics first, okay? So, but just in the basics of the inside bar breakout, just in terms of the inside bar breakout, you never want to trade the inside bar. You only want to trade the break of the inside bar, because remember, the inside bar represents a state of consolidation. So this answers the question of, when you see an inside bar, do you get in the trade right then at that moment? No, you do not. You wait for the break of the inside bar to get in the trade. So for those of you that trade daily candles and you see that, oh, price is inside one day, and shout out to CyberDoc, he's gonna tell you that, oh, if it's an inside day, he'll let you know. He will let you know. Nope, price didn't. We're stuck. We are stuck in a range, and you're not supposed to do anything. That is in the definition. By definition, that is true. You are supposed to wait for tomorrow to trade the break of the inside bar. So I hope that's making sense to y'all. If you see an inside bar today, you wait for tomorrow to trade the break of the inside bar. Okay, because I know that's going to help with a lot of questions. I see the inside and they say, oh, I got in, I thought it was it's still inside. Because a lot of times you're going to hear me, I'm going to say, it's inside, it didn't do anything. They're like, but it went down. Nope, it's inside. It didn't do anything. Consolidation, it didn't do anything. Inside bars are consolidation candles, and you should assume to be faked out, but the break of the inside bar leads to the expansion. In this state, the consolidation is also known as what we call choppiness. Okay? Now, does that make sense so far? Does the inside bar breakout make sense? How we trade the inside bar? I want to make sure that you guys are. Sit on your hands, Dave Robinson would say, yes, you got it, Sean. You got it. You got it. Trust me, trust me, trust me. Yes, yes, yes. What do I do while I wait? How do I find my patience to wait? Well, a lot of people will hear me in the Discord, playing it in the Discord, or if there's an inside bar, I'm gonna say, well, get up from your seat, go for a run, go walk your dog, go take your kids to school. Don't do anything, because as traders, it is better to do nothing than to do something, especially if you're in a state of consolidation. Okay, so hopefully that makes sense. You guys are getting it. Cool, cool, cool. Now onto the hammer. Let's go to the hammer. So what is a hammer? So a hammer forms after a previous lower trend series to potentially signal a reversal. And actually, let me make sure if the hammer, okay, here we go. So a hammer forms after a previous lower trend series to potentially signal a reversal. Visually, a hammer is represented by the open and close being at the top half or top 33% of the candle with a long shadow to the downside. Okay? The shadow represents exhaustion or downside sellers. And the hammer indicates that price was being brought up or brought down, being brought down until buyers stepped in and shot the price back up. Okay, so you guys don't see the image here, but I'm going to show you guys in the next slide. Visually, what you should know is that a hammer forms after a previous lower trend series to potentially signal a reversal, and the hammers indicate that price was being brought down until buyers stepped in and shot the price back up. Let's look at it on this slide. So you can see on this slide right here, you can see that price, we were originally in a downtrend, lower low, lower high, lower low, higher high, but the next candle made a lower low and a lower high. And then we made a lower low and a lower high. But what happened in this candle compared to these other candles right here? You can see that price came down, indicated by the wicks. Remember, we know what a candlestick is. We understand that price came all the way down here because the shadow represents that price came down to this extreme, but then it got brought back up, or bought back up, I should say, by buyers. This indicates buyer pressure or seller exhaustion or ill-timed shorts. Okay, now what is important about the hammer is that a hammer is an actionable signal, but it is not a universal truth. And the reason why it is not a universal truth is because we don't know why the hammer was formed. We don't know if it was due to seller exhaustion. We don't know if it was due to buyers now stepping in, or ill-timed shorts. We don't know, but we do know, or we can do something based off the hammer. The hammer is actionable because should the condition, seller exhaustion, buyer aggression, or ill-timed shorts be true, the probability that the hammer will send price higher is increased. Okay? I want you to think of it in terms of psychology. What is going on in this hammer right here? Price comes down and all of a sudden buyers step in, or seller exhaustion, and price is now coming up. Price is continuous. You can see that if these new buyers came in, what did they do the next day? They continued buying. And all they did was continue buying for the next couple of days. The only reason why that this candle stopped, or there's a break between this candle, is because of, you guys have heard me say, 4 p.m. Eastern, right? That is the only reason why the buying, quote unquote, stopped. But we know price is continuous. People stepped in this candle, they bought, and they continued to buy for the rest of the days. Okay, so I want you to think of a hammer building something up. Okay, that is important about the hammer. Now, what is a Momo hammer? But actually, before I go into the Momo hammer, there's something important about the hammer that I want to mention that's very important. The hammer does not become actionable until the next candle triggers 2 up off of the hammer. So I'm going to say it again. This hammer does not become actionable until the next candle triggers 2 up off of that hammer. Why is this a 2 up candle? Remember, by definition, it breaks the high of the previous bar, making a higher high and a higher low. So whenever you see a hammer, and we're going to look at trading view charts. Whenever you see a hammer, yeah, you can get excited. Oh, we're possibly going to reverse. We're possibly going to go up, right? But technically, the hammer is not actionable until the next candle goes 2 up. And that's why sometimes you guys are here, like sometimes we'll get into play early because it's building a hammer, but then the next day if it gaps down, I'll say, oh well, there's nothing we could do because the hammer never became actionable. Okay, hopefully that makes sense. Now onto a Momo hammer. So what is a Momo hammer? A Momo hammer is momentum hammer is a hammer that forms near the high of a strong previous uptrend. The wicks represent a pullback or profit taking or ill-timed shorts, and just for the trend to continue higher. I'm going to show you guys trading view today, but SPY had an example of a Momo hammer today on the 90-minute. Actually, in fact, this picture right here is SPY on the 90-minute today. SPY had a momentum hammer breakout. Now, how do we know? What the momentum hammer is a hammer that forms near the high of a strong previous uptrend. You could see that SPY is in an uptrend, and the hammer forms near the previous high. You see that price wicks down, but all of a sudden buyers step back in. So what does this look like? And the reason why I'm glad I'm showing this example, because for those of you that traded today, you can actually think about the psychology. If you were actually paying attention to the market all day, what happened? If you were trading SPY, or if you were trading any calls, we saw that pullback occur in the market, like in the first half of the market, before rallying higher. That was just a pullback for the market to continue higher. That is the momentum hammer. Tie that in with the inside bar, actionable. But remember, the hammer becomes actionable on the break of the next bar. All right, so that is the momentum hammer. Let's talk about the shooter now, okay? The shooter, the opposite of a hammer. I want everyone to just think about it pretty much like the opposite of the hammer. A shooter forms after a previous higher trend series to potentially signal a reversal. Remember, just like with the hammer, it forms after a lower trend series to potentially signal a reversal to the upside. A shooter comes after an uptrend to potentially signal a reversal to the downside. And a shooter occurs when sellers start taking profits. Visually, the shooter is represented by the open and the close being at the bottom half or the lower 33rd%, or I like to say 50%, of the candle with a long shadow to the upside, okay? This shadow right here, you guys remember what the candlestick looks like. It represents exhaustion of buyers. And these signals occur when sellers start taking profits. What we love about candlesticks, remember how I talked about the candlestick formation? How I said how the candlestick will literally tell you what's going on in the candle. The shooter, you literally know what's happening. It could be a combination of seller exhaustion or ill-timed longs. We'll talk about it. So a shooter is an actionable signal, but it's not a universal truth, just like the hammer, because we do not know why the shooter is forced. It could be a combination of buyer exhaustion. No, there's no more people slamming the bid, or selling pressure. Now they want to sell. Now they want to short, or ill-timed longs. You don't know, but should the condition be true, whether that's buyer exhaustion, selling pressure, or ill-timed longs, the probability that the shooter will send lower prices or send price lower is increased. The shooter does not become actionable until the break of the next bar. Okay, so just like with the hammer, I want people to write this down because it's very, very important. It's going to save you by getting in plays early, right? The shooter and the hammer do not become actionable until the next candle breaks either the high of the hammer or the low of the shooter. In this case, you see that this candle broke the low of the shooter. All right. Does this make sense so far? I hope you guys are still with me. I want to make sure, no, I'm not making anybody sleep. I know it's starting to getting toward that time. Night's starting to come. Are we still okay? Are we still okay with the actionable signals? So far, we talked about the inside bar breakout, going from a consolidation to expansion, going from equilibrium to expansion. We talked about the hammer when price is now being brought up after it was originally coming down, and it leads to an increased probability of price going higher. We talked about the shooter, how we talked about originally we are in an uptrend, but now the people who are buying are no longer possibly are no longer in the play. Now you see it being reflected in price, price coming down, and it's not until the next candle that you take the short to go short. Perfect, perfect. We good? Okay, beautiful. I like it. I like it. All right, good. So we talked about the Momo hammer. Same thing with the Momo shooter. So I won't go into detail about the Momo shooter, but let's talk about the ref strat. Okay. So what is the ref strat? The reversal strategy, or the ref strat, is a reversal of the inside bar setup, and usually it is one side. It usually is, or how you would see this is that one side attempted to break out, but has now been met with a stronger force in the opposite direction, and now price goes to the opposite side. So you'll see that the equilibrium breakout was attempted for one side, which we know is a universal truth because we went from a state of equilibrium. But if that side does not break in force, this leads to a reversal pattern. Okay, and this is true. Someone say, why is it a universal truth? Well, because we know things are for sure. We know that we went from a state of equilibrium. We know that one side attempted to break out, but now it is coming back into the range and is now going into the opposite side. Those are universal truths. Okay, and this example right here, we have our inside bar. This was a 2-up candle, failed 2-up candle, and you see that the following day price went down. Price attempted to go up to go down. Is it a Brownian formation on a lower time frame? Yes, yes it is. Yes it is. Yes it is. But we'll definitely talk about that. Okay. So now let's go on to the next. I hope people understand the ref strat, and don't worry, I'm going to be going over trading view examples. Okay. That is what the reversal strategy is, and it's very important. Is the opposite of the inside bar. Another example right here, and this happens to be Nvidia's chart, where we went from a state of equilibrium, and on the weekly, we went from a state of equilibrium. We had a 2-down candle. This candle couldn't take out this range right here, just for price to reverse back to the upside. Okay, and that is the reversal strategy. Once you get good at understanding actionable signals, you can use that in combination with the strat combos to find high probability setups. So the strat combo guide, and I want to say shout out to Sarah the Strat Sniper, shout out to AdexTrades, shout out to every single one of you that created combo guides and combo cheat sheets to help us, and so we can understand these combo cheat sheets. Thank you. Now, the reason why the strat guide and the combo guide is very, very important is because it gives us clear entries and exits when price triggers a certain strat combination. And for those of you that don't have this, make sure you guys have this either posted on your wall. Make sure you guys have this printed out, because this is very, 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 very important. Very, very important to understand combinations. It's how we know and how we can talk to each other and how we understand where price can particularly go to. Okay, so let's talk about a couple of these combos right here, and let's talk about, let's look at the 2-2 bearish reversal. Okay, so the 2-up, 2-down bearish reversal. So in this example right here, this is a strat combination, and what the strat combination tells us is that price attempts to break the high of this candle, and then the third candle goes down. So this is a 2-up, 2-down reversal bearish pattern, and you can see that signified right here. So how would I say it if I'm like trading live? I would say, hey guys, we have a possible 2-2 reversal on the daily, 2-2 reversal on the weekly off of a shooter, right? We know that the probability is increased, one, because the shooter, and we also know that if this strat combo triggers, not only do we have our entry, we also have our target. Look what happens in this example. Entry, target. Look where it goes. Okay, so hopefully you guys can see it. Entry, target, look where it goes. That is why we love these strat combinations, is because when something triggers, we know where our target is automatically. Now, is it gonna go there? We're not saying it will for sure go there. But the beauty about the strat is that it gives us our entry and our target prior to us even taking the trade. As long as it triggers, we have our potential target and we expect price to get there until proven otherwise. Okay, that's a 2-2 reversal. Let's look at a 3-2-2 reversal. Okay, this is a 3 down, 2 up reversal. Based off this strat actionable combo, or this strat combo, this tells us that we take the entry off the high of the second or the first 2 bar, and the target will be the top of the 3 candle. Look, this picture right here from the strat combo tells us if the entry should be at the top of the 2 candle, or when we break the high of the 2 candle and we take it to the target at the top of the 3 candle. Look at what happens right here. Entry at the top of the 2 candle, take it to the top of the 3 candle right here. Am I making, are these strat combos making sense so far? I want to make sure that these strat combos are making sense so far. Are you guys getting it? Are we getting it? Are we getting it? You see what you guys are saying? Good. How we feeling? How we feeling? Good. Are we getting these reversals? Are we getting these strat combinations? And don't worry, like I said, we're gonna go into detail and we're gonna look at more examples. I just want to make sure you guys are getting it. Cool. Perfect. All right. So once you guys start to understand about the strat combinations, like I said, there's a lot of it, so we won't go into detail now. But as you put the 3 universal truths together, actionable signals and the strat combinations increase evidence to help change our determination from possible outcomes to probable outcomes. Okay. One of the reasons why, and it was funny, a couple of years ago, I remember there was this whole Twitter phrase where people thought that like stratters were cocky because we always said like, oh, we know, like, did we know? And the reason why you'll hear stratters say that phrase, did we know, shout out to Rob, is because of the fact that we take possible outcomes into probable outcomes. One of the reasons why I love the strat, and you guys hear me talk about this every day, because I've never found a trading strategy that literally gives us an empirical or a statistical number to how probable a setup is. I talk about it all the time. If you literally are looking at something and it's telling you there is a 70% chance, and not literally, don't take it for literally, that this can happen, you're giving me data behind something that can happen, I'll take it any day. That is why the strat is empirical, because it takes possible outcomes into probable outcomes. What do we mean by possible? It could go up, it could go down, it could go nowhere. To probable, it is highly likely to go up, or it is highly likely to go down. For those of you that are on Twitter, y'all know some strategists, we be talking that talk. And rightfully so, proudly so. I want everybody to understand, proudly so, we be talking that talk. Because we, not only do we do our homework, we are basing our talk off of probable outcomes. Yes, we understand that trading can fail. We understand some setups can fail, right? But if we know that over time, we will be taking probable outcomes or probable setups, how can you be a failure? And that is why, I won't go into detail, but I talk about how the strat is more than just a trading strategy. It's more than life, really. Because I talk about, broadening formation, how price, I'm going into detail. We'll go later into that. All right. So actionable signals and the strat combos. It takes possible outcomes into probable outcomes. Okay. So based off what we know, everything that we've learned so far, everything that you've learned so far, what do we really know about the strat? So here's the truth about the strat. We know a couple of things. We know that there are three universal truths to price action, which refer to broadening formations, time frame continuity, and actionable signals. We know that price does not move, that it aggregates. And the way price aggregates can be described as the three scenarios: the inside bar, the directional bar, or the outside bar. The strat takes an objective approach to technical analysis. It's not subjective. So we have no opinions and speak only in description of what we know to be true. And finally, we want to evaluate what conditions will be created if the actionable signals are successful or they fail, and how they will confirm, conflict, or change time frame continuity. Okay? So, are you all with me so far? These are the foundation and these are the truths about the strat, and these are the things, literally print this out, you should always be thinking about when it comes to the strat. These are the truths about price action. And once you understand these truths about price action, it will open your eyes so much. You can ask anybody here that trades the strat. It will open your eyes. But I talk about how, you see how I talk about how that price does not move, it aggregates. What do I mean by that? That leads me to my next topic, which is price action is fractal. Okay? So, what are fractals? Fractals are infinitely complex patterns that repeat across different scales. Sorry if I sound all scientific, my bad. Just want to give you a definition. They are extremely familiar and exist everywhere in nature. If you guys have seen like a snowflake, that's like what a fractal is. Because like the inner shapes make up the outer shapes. Yeah, hopefully that makes sense, right? So if you've seen a snowflake, that's what a fractal is. So technical analysis is derived from the analysis of human math psychology. And since human behavior is repetitive, fractals exist in markets. Financial markets are naturally fractal in shape and structure, meaning that the same patterns appear over time. Larger patterns or trends are built from the aggregation of compounded smaller patterns or trends. And these patterns play out sequentially over time, but time is always relative when dealing with future outcomes. Remember, y'all notice how everything always relates back to time? But time. You guys have heard me, time, right? The strat demonstrates the fractal nature of price action. Okay, Adex, you just confused me. What are you talking about? Now you talk about snowflakes. We were just talking about trading. What you mean? Well, let me go into detail, okay? So for those of you that are familiar with the 212, and if you're not familiar with the 212, I'll definitely show you. But for those of you that are, right, a strat combo on one time frame has the same result on another time frame. Since price action is fractal, a 212 on the hourly time frame is equivalent or has the same magnitude as a 212 on a monthly time frame. Now, when I say equivalent, what I mean is in the literal sense that the 212, once it breaks, this two candle breaks the high of the one bar, right? It has the magnitude to get to the opposite or to the previous two. Same thing with the monthly chart. Once the two candle breaks the high of the one bar, it has the magnitude to get to the preceding two candle with the 212 breakout. The only difference between these two, the hourly 212 and the monthly 212, is the time that it gets to target. You guys have heard me say it will take an hour or potentially an hour for the hourly to get to target, and it can take a month for the monthly to get to target. I'll show you an example. Okay, so in this, I have two charts right here. Okay, in this first chart, we see that, okay, you have a green candle, uptrend, you got a green candle followed by a red candle, inside bar, then the next candle goes two down. All right, so you have a reversal pattern. Same here, same thing with the chart on the right. You have an uptrend, you have an inside followed by an inside bar, then the next candle goes two down. So we see that essentially like the same thing happened, right? It went up, consolidated, then price went down. Now let's look at the next example. You can see, first of all, these are both the same charts that I had in the previous example, but this one represents Apple on the daily, while this one represents AMD on the monthly. Okay, you can see that price essentially did the same thing for both stocks. They went up, consolidated, then went down and went to the target. But the difference is that it took Apple 1 day to get to its target, while it took AMD potentially 1 month to get to its target. What was the difference? Time. The only difference is time that it gets to target. Okay? And so that's why, and for those of you, like, we get a lot of questions like, oh, does a strat work for day trading? Does a strat work for swing trading? Strat works for every single trading, because the only thing that you need to, not the only thing, but what you just need to take into account is the time element. So a 212 on the 15 minute is the same thing as a 212 on the weekly, or a 212 on the 1 minute. I know y'all some ICT folks, is the same thing as the same on the monthly. But on the 1 minute, you know that's getting a target in 10 seconds or something. You get what I'm saying? So that is the only difference, and that's why you guys, I tweeted this. I had a tweet, and I say, like, take the watermark off. I say, I forgot what I said, but I said take the watermark off your screen. All you got to do is show me the 1, 2s, and 3s, because and that is price action. That is why price action is so not scary, but it's why I say that price action you want to learn first, because you can take that watermark off your screen, and if you just knew the 1s, 2, and 3s, you can tell if we're in a state of consolidation, if we're in a state of direction, if we're expanding the range by going outside. You know by just looking at the candle, irregardless of what the watermark told you. Hopefully that makes sense. Okay, so what we see on what time frame is essentially what we see on another time frame. Understanding that the patterns on the lower time frame create or influence the patterns of the higher time frame. Therefore, I personally believe that traders should not focus on one time frame. I personally, I can't, when I'm doing my homework, I talk about doing homework, you should not be looking at charts on one time frame, because when you're looking at the daily chart, you should also be paying attention to the weekly chart. As the day pushes up, what does that make the weekly candle look like, right? In this example, you can see that this is a fractal nature of this chart. This is the 2-week chart, the 1 month, and the 2-month chart. The 2-week chart makes up the 1 month chart. The 1 month chart, these two candles on the 1 month make up the 2-month chart. This 2-month chart right here is the composition of these two candles right here. And these two 1-month chart is the composition of these 4 2-week charts right here. So that's what we talk about with price action is fractal. You need one time frame to influence the higher time frame. And that leads to the next point, which is the concept of multiple time frame analysis. All right. Are you guys still with me? Are you guys bored yet? Did I bore you? People snoring? How we doing? I got people snoring. We got a little drop down. We got like 12 people that leave. I think, time. They probably got some kids, school tomorrow, things like that. That's totally understandable. Probably got to eat some dinner, so apologize for that. But we still doing good? Let me make sure. This actually, and to be honest with you guys, this is actually going to be the last part before we go on to his examples. So I hope you guys still here with me. Good. Appreciate it. All right. So multiple time frame analysis, okay? So multiple time frame analysis is a essential tool to the strat. Thank you all so much. I appreciate you guys. Thank you. Okay? So it's an essential tool to the strat. It helps traders identify the strongest assets to trade or with the most magnitude. It involves looking at the price and candlestick formation on multiple time frames to confirm the strength of the trend. And by using multiple time frames, traders can ensure that they are on the right side of the market, and which increases the objectivity of their trading strategy. Okay, so let's look at this example of QQQ. This example, and this wasn't today, this was another day, obviously it wasn't today. But if you were to look at this example of QQQ, I would say like, okay, we had a green day today, almost closed as a doji. You're at looks like you're at a support. Maybe this is a broadening formation. You might have two broadening formations right here. Man, I think this should probably go up, y'all. I think this should go up, right? Now, I wouldn't say, and someone would say, hey, ADEX, like, or this, we have a potential 322 reversal back to the upside. Of course, yes, we do. Potential 322 reversal to the upside. And I wouldn't even say if you're wrong, right? But if you were to look at the higher time frames, you can see that maybe you might not want to go long on tech. Because one, first of all, shooter on the quarter. You know, on the quarterly time frame, or the quarterly participants, they have been selling the entire quarter. If you were to look at the monthly time frame, you can tell that they've been selling the entire month. And not only that, it's an inside month. So you got double the mess up by having consolidation as well. And then you have a 3-2 continuation on the weekly chart. And we know 3-2 continuation, for those that trade the strat, we know how powerful those are. So if I were to look at this chart in more than one time frame, I would probably second guess of me wanting to go long, even though I know it's possibly a broadening formation, maybe even a short-term reversal. But we can tell that based on the higher time frames, we may be getting more downside. Okay, so that is why, one of the reasons why you should be looking at things in terms of multiple time frame analysis. That is why you see traders or stratters, sorry, not traders, stratters, look at things with more than 4 screen or more than 4 charts, because we want to get a better visualization of what price is trying to tell us of where it could potentially go. Okay, hopefully that makes sense. Now, that was part 1 of the beginner's guide to the strat. Now, I do have part 2 available for you guys as well, but in the interest of time, I wanted to ask you all, did you guys want me to go over it, or did you guys want to go straight to the trading view examples? Remember, this session is for you guys. So if you guys want me to continue to go on with the part 2 with trading the strat, there's going to be about maybe 6 more slides, and I won't try to take too much of your time. I know you guys are itching for examples, but what would you guys like me to do? Please let me know. Let me know. We still got 220 people on board. Wow, I appreciate you guys. You guys are here. You guys are here. Thank you all. Go over. Oh wow, that was in caps. He said go over it in caps. Okay, okay. All right. Yes, go over it. Okay, more go over it. Can we examples and do part 2 another time? Someone said go on. Let's do part 2. Part 2. Let's go. Okay, let's go. Okay. Okay. All right, Ryan, I will try not to spend too much time. I'll try to just go over these concepts, and then we can look over trading view examples. All right. So part 2, trading the strat. So trading the strat. So the entry, when it comes to trading the strat, you guys already know the inside bar breakout, which we'll talk about. So when it comes to trading the strat, the entry is the break of the high or the low of the candlestick, and your exit are the wicks of the preceding candlestick. Okay, I'm going to say it again. Your entry is the break of the candlestick. So if you were to look at this example right here, you see that we have an inside bar. Okay, the inside bar, once price breaks this inside bar, this is your entry. And your exit is the preceding candlesticks. So you look to the left. We always talk about look to the left, look to the left, look to the left. Those wicks of the preceding candlesticks, those are your exits, okay? And that's one of the reasons why the strat is straightforward. They give you your entry, break of the actionable signal, and they give you your exit, the wick of the preceding candlesticks. Good? Okay, good. On to the next one. So, previous candlestick highs are used as price targets. We use tight stops if that action, actually, let me back up. So previous candlestick highs or lows use price targets. And for our exits, before I say tight stops, I like to talk about invalidation levels, okay? So if you're trading options, we use invalidation levels, not tight stops. I know people are gonna be like, whoa, what are you doing? Oh, just hear me out, hear me out. We trade options. Remember, this for shares is different, but we trade options. And if you're swinging options, or not even swinging, just trading options, the reason why tight stops is kind of difficult to control is because we have the Greeks, okay? We have the Greeks that we have to take into account. So what I like to do instead of using tight stops is that we want to start with starters, okay? So you want to start with a starter, then if the price or if price is actually going or confirming your trend, then you can add onto your position, okay? So remember, this is trading options, and we'll go into more detail about it, but tight stops is a little bit different, and I know everyone has their own method, please, and to each his own, but it's just a slightly different because of the Greek components that are part of the nature of options, okay? So the inside bar breakout, I talk about how price targets are the wicks of the preceding bars. This is where buyers and sellers place their stop loss. And I also like to think of this as a point of decision making. Remember, you're now a trader now. You took the breakout. What do you want to do when price gets to this high right here, which happens to be your price target? You need to decide if you are going to get out of your position, if you are going to add on to your position, or if you are going to trim your position. And the reason why is because the previous wick is where previous buy or sell orders reside, and that you should expect a reaction to happen at that previous or preceding wick. So let me ask y'all, let's say you go long on a stock, and let's say you put a lot of capital, more than you shouldn't have, right? And all of a sudden price goes up, and you see that price goes up, and you're about to approach the preceding or the previous wick. If price gets there, and now all of a sudden price pulls back, and you're now down, let's say 30%, and you're asking the question like, wait, why did price pull back? I would tell you that, hey, we hit a wick. That is a point of decision making. Now, strategists are going to say, wait, that's a horizontal line. You don't price that. That's why I said it's a point of decision making. We're not saying that price is literally going to reverse at that part, but what we are saying and what is true is that previous market orders reside, and that can be an area where you can get price reactions. Okay, so that is why you need to make a decision at price targets. I'm always going to talk about price targets, and a decision must be made at that price target. Now we talk about our exits. What about our stop losses? So remember how I talked about tight stops and how it's kind of a little bit different? So with trading options, it requires a different set of rules. And where stop losses are based on the underlying stock price, not the contract price if you're trading options, okay? And the reason why is because it's more complicated as Greeks are involved. You use invalidation levels, not tight stops. And I like to use, this is for me, my first point of invalidation for any trade that I take, for any option trade that I take, is the 50% of the previous bar or of your entry candle. That, because that determines, I'll go into that later, that determines bullish and bearish bias. 50% of the previous and of your entry candle. That is the first point of invalidation. Okay, so what else helps us stay in the trade longer? If you're not going to use style, you say, okay, now ADEX is saying is based off the underlying. Okay, so it triggered 2 up on the day, but then price retrace. Do I get out now? No. Why? And why will I say that you probably shouldn't get out until price reverses? The reason why I will say don't get out until price reverses is because of the fact that the TTO phenomenon exists. Okay, triangle they out. Triangle day out is another Robism, and the TTO phenomenon, also known as a triangle day out, is another word or a fancy word or a fancy phrase for just a pullback or a retracement. We're going to talk about it in TradingView. The TTO, because you're going to hear it, because like I said, for those of you that are new, we're going to get you into the strat. You're going to hear us talk about, oh, we have a potential TTO. You need to know, what are they talking about when he says TTO? It is a pullback or a retracement back into the original trend. Okay? And it looks like a triangle on a chart. It gives you possible areas to add onto your position. And I also say that you want to assume a TTO until proven otherwise. Now, what do you mean it looks like a triangle on a chart? Well, if you were to look, this is what we mean by a triangle on a chart. Triangle day out. Now, let me explain the psychology behind the triangle day out. Let's say you were to go long, right? So you're long Costco. Let's say you're trading options, and you took advantage of this inside bar, right? Price is going up, and you're like, oh yeah, we're up 30%. Next day gap up. Oh, we're up 80%. Next day gap up. It keeps going up, right? And you're up so much. Let's say like at this point, because your entry was here. We know Costco. Costco moves from here to here. That's a nice move. But let's say you still have runners or you still have position at this high. Price comes down now, right? And you are now getting worried, and you're telling yourself, you're like, oh snap, God, man, I should have took profits at that high. I knew I should have took profits. I shouldn't have been greedy, man. I should have took profits. And price keeps going down. You're like, oh, maybe it'll go up tomorrow, but it keeps going down. Oh, maybe it'll go up tomorrow, but it keeps going down. Oh, maybe it'll go up tomorrow. It keeps going down. Finally, it gets to a point where you can't handle it anymore. You want to take your money because you're like, you know what? I don't want to see. This can't go red. This can't go red. You get out of your position just for price to reverse, go back up. How many times has that happened to anyone in the chat? How many times have you gotten into a trade and you see that the trade is now pulling back and you're like, F it, let me get out, just for the trade to end up working in your favor and reversing back to the original trend? All of us have. All of us have. And that is the TTO phenomenon. I tell people the TTO is probably my favorite thing when it comes to strat. Besides maybe like the 1-3 setup, the TTO is probably the favorite thing, because once you know what TTO exists, you won't be scared of a pullback. Once you know a TTO exists, you won't be scared of a pullback. And it also helps with the mentality of swinging. And we ain't gonna talk all there's a whole different mindset when it comes to swinging, but TTOs is a part of price action. I talk about NVIDIA, and I'll go over NVIDIA's chart, but NVIDIA all last year, all it did was TTO. NVIDIA is still TTOing up to the upside. NVIDIA has not stopped TTOing. Oh, actually, what am I talking about? NVIDIA has not stopped. NVIDIA in an infinite TTO right now. NVIDIA is an infinite, it is TTO. That's why when people say, you guys see people say, don't short NVIDIA, like don't short NVIDIA. Why? Because when NVIDIA comes down 3 days and all of a sudden it makes a new high. Triangle day out. That is what the TTO phenomenon is. Someone says 6 hours ago. Trust me, every time, it happens all the time. And that's why I don't want people to be guilty. I don't want people to feel bad if it happens to them. Because you have to understand that exists. You have to understand price needs to come down in order for it to go up. That is what the TTO is. And when you start using things like time frame continuity, multiple time frame analysis, that's when you can really start milking plays and things like that. Here's another example where this is a breakout where if you use, because I also like to use not just the strat, just not the strat actionable signals. I also like to use some indicators as well. I know some people are going to be like, wait, you use indicators? Yes, some indicators. And I am a proponent for indicators as long as it helps you. I'm going to say this. As long as the indicator helps you and it does not prevent you or give you a conflicting view of price action, I'm perfectly okay with that. I know you don't care what I say, but as long as it does not affect price action, I am perfectly okay with that. If it gets to the point where your RSI is telling you that this market is overbought and you just see full-time frame continuity to the upside, take that off. And I'm sorry for the RSI traders. I'm sorry. But price action is key, because those same RSI traders were the same ones telling you that 2020 was overbought and it kept going up the entire year, and they ended up missing the rally because their RSI was over 90 or whatever. Price action precedes technical indicators. So with that being said, price action first, and then use technical indicators in alignment with price action. That's all. It can be a chart pattern. It could be a breakout. In this case, you guys see, I just have a simple downtrend line. We broke out of the downtrend line. We retested it, TTO'd off the downtrend line to go right back into trend. Okay? So it's very important. As long as you understand price and understand the phenomenon of the TTO, perfectly fine. Okay? I'll even say, or you will see that the strat often signals when a potential TTO is coming. In this example, this is SPY on the 15-minute time frame. Okay? So we have a 15-minute time frame and you have an inside bar. Notice how price is going down. Two down, inside bar, two down. It was making lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. Then you have your inside bar. You have your inside bar at the bottom of a downtrend. Once you get the 2-1-2 reversal paired with the trend line break, look what happens. Okay? So, and it's also important to note that the TTO is a broadening formation on a lower time frame. Okay? So when price moves up and price starts to coming down, it's creating a broadening formation. And what are you doing? You are simply waiting for broadening, for price to for seller exhaustion, I guess, for sellers to be exhausted, and for price to reverse to the upside. So I will tell people, or you will hear me say, hey, we have a potential TTO. Hey, we have a possible TTO, because you don't know exactly when the TTO is going to happen. It's going to give you a potential signal, right? An inside bar. We didn't know that these candles were there. We only saw the inside bar. But because of the inside bar and because we know about the TTO phenomenon, we would say, hey, you guys, this could be a potential TTO to the upside because the original trend was up. And this is where that broadening formation was created. Okay? It's very important to understand the difference between a TTO versus reversal. When we say when I say assume a TTO until proven otherwise, this answers the question of what is a TTO versus a reversal. A TTO, or what I like to say, or in my definition, a TTO is a pullback when in full time frame continuity. So oftentimes, like right now, I mean, minus CPI, let's say CPI wasn't tomorrow, but when you see red week, red month, red quarter, green week, green month, green quarter, but a red day, oftentimes I'd like to think that red day is going to be a TTO back to the upside, in alignment with full time frame continuity. How many stocks were red yesterday that all of a sudden were green today in alignment with full time frame continuity? Okay? A 2-2 rev, a 2-1-2 rev, a 3-2-2 rev on a lower time frame is what will constitute a TTO. A reversal signifies a true trend change. And this can be, and you can see this due to exhaustion risk, whether it's broadening formation exhaustion or you hit a supported resistance level. And I won't start saying that price will enter reversal stage until you get to 50% of the previous bar, because this now separates bullish and bearish territory, and we know we're going to talk about that. So a TTO is different from a reversal, but I need you guys to understand, you won't know a TTO until it actually happens. So that's why you're assuming or anticipating a TTO until proven otherwise. So when NVIDIA is going up and it continues to go up, every single time it has a red day, I am going to assume it is a TTO until proven otherwise, until we have higher time frame participants telling us that they are out of the trade. Okay? So once you understand the difference between a reversal and a TTO, let's put everything together. So how do we trade the strat? We understand that that there are universal truths of price action. We know broadening formations exist everywhere and are used to gauge magnitude. We gauge probability using if-then statements. If this works, then what will happen? Setup, trigger, or confirm. If this fails, then what will it set up, trigger, or confirm? We enter based off actionable signals, and we trade in the direction of full time frame continuity. So I kind of put this all together, just looking at it together, and pretty much came up with this. How we trade the strat. We understand, we know, we gauge, we enter, we trade. And that's how we trade the strat. And that is the end of my presentation. How did you guys like that? How did you guys like that? That is the conclusion. Of course, now I'm going to be going over some trading view examples, but how do we feel about that presentation, y'all? I'm sorry. Like I said, how did we, 2 hours? My apologies. My apologies. That took a little 2 hours, but how did we feel about this masterclass? Did you guys learn some things? Was it insightful? Hope I was able to teach you guys, especially for those of you that are new. Like I said, we're going to be going over some trading view examples, but okay. Thank you. A plus, Nori. I appreciate that. Such a good presentation. Thank you, Sasuke. Thank you. Sector rotation. Yes, we can definitely top the top notch, but thank you. I appreciate that. Thank you all so much. Thank you. All right, I appreciate that. Wow, man, it makes me so happy. You guys have no understanding. I'm literally smiling from cheek to cheek right now. Thank you so much. All right, let's go over some trading view examples. I know we want to go over some trading view examples, and I also will be taking questions as well. This will be an opportunity for those of you to please ask some questions in the chat. We'll be going over some trading view examples. Okay. Let's bring up trading view. Make sure. Let's go. See what we got right here. Day traders and the same type of day trading on preference. Yes. Great input. Hey, I appreciate that, Fernando. Thank you, man. Thank you guys so much. Thank you guys so much. Really do appreciate it. Really do appreciate you guys taking out the time. Wow, I'm glad. Thank you. Yes, and this also will be recorded. Like I said, this is free. The strat everyone should learn the strat. Like, I'm sorry if I'm sounding like an optimist or I sound like great, but to me it's fun. It helped me learn. It helped me understand price action. It helped me understand how to trade. I went from being an Elliott wave theorist to trading the strat. And it just opened my eyes to just understand price action. And not only that, it's not just like, oh, I understand price action. It gave me the confidence because of the fact that the probability of the statistical nature of the strat, especially for those of you that are mathematicians or you guys who like working with statistics, I promise you the stat, it's phenomenal. It is phenomenal. You play what you know to be true. There is no guessing about it. You see a 3 bar, it's a 3 bar. You know what happened. Price broke the previous side of the range. You see an inside bar, you know what happened. It's equilibrium. Nothing is going on in the inside bar. You know when you see equilibrium, something is about to occur because you need to expand from equilibrium. Imagine when you're just staring at charts and you see inside bars all day. You guys know what to do. All right, I appreciate every single one of you. Let's go over some trading view examples, okay? So let's talk about the 1s, 2s, and 3s. And in this case, I'm actually going to talk about SPY on the 5-day chart. And remember, if you guys have any questions, please feel free to ask, okay? Please feel free to ask. Now let's start from here. So the 1s, 2s, and 3s about and the 1s, 2s, and 3s, scenario 1, scenario 2, scenario 3, price action. Okay, so scenario 1, we know it represents consolidation. I want you guys to look at this chart right here. So let's just start from here, and this is the 5-day chart. We see that price, we're gonna start from this candle right here. We see that price is in a downtrend, right? Signified by lower lows and lower highs. So this is, and actually, I'm sorry. You can. Okay, so I have the 1s, 2s, and 3s. You see that these are 2, and actually, let me do this for you as well. There we go. Hopefully that helped. So this should help. Okay. Well, hopefully this helps. So green and red, right? Especially for those of you that are new. So you see this 2 candle, and after this 2 candle, we have a 2 down candle. Okay, what makes this candle a 2 down? It broke the low here. You see that it broke the low of this bar. Okay, so that's what makes this a 2 down candle. It broke the low of this bar. It did not break the high of that bar. So which is why it is a 2 down candle. The next candle also breaks the low of this candle. So if you just move it down, boom, breaks the low. Okay, 2 down candle. If you look at this candle, boom, breaks the low. Some people, oh no, that's nothing. There's 2 down candle. Now, it is not until, I want you guys to look at this. Why is it that all of a sudden the trend started changing? Look at what happened. You had an inside bar. So think of it like this. You had selling, 2 down, 2 down. We know sellers are here, selling, selling, selling. Then all of a sudden you had an inside bar. Inside bar represents consolidation, represents equilibrium, disagreement between buyers and sellers. Sellers wanted to bring price down, but buyers are like, no, we don't want you to bring price down anymore. And that is why they're at a state of equilibrium, because I like to think of it as, quote, they're fighting each other. Then following them fighting each other, or them playing tug of war, you get the reversal candle, the 2-1-2 up reversal. Now, this is an actionable signal on a lower time frame. If you see, or sorry, not an actionable signal on a lower time frame, this is just an actionable signal. This is simply the 2-1-2 reversal. And if I show you right here, 2-1-2 reversal, 2-1-2. Boom. Okay. 2-1-2 bullish reversal. Hope you guys can see that. Okay. 2-1-2 bullish reversal. Then you can, where's our target? This is your entry at the top of the 1 bar. Entry right here. Look at this. Entry. And your target is that top of the 2 candle. Look. This is the top of the 2 candle. This is your target. ET. So you see how, and even if I were to do this, look, price literally gave you a setup saying if price breaks this inside bar to the upside, you can get to target. And does it get to target? Yes, it does. That's one of the reasons why we love this strat, because there is no if, ands, or buts about target. You'll hear all day in the chat, we talking about where's your target? Oh, my target here. Like, we have defined targets when it comes to strat, because literally you use the preceding wicks of the candle. Okay, so following that bar, if I were to reverse, now we have 2-1-2 continuation. Then we have another inside bar. Look at what happens after the inside bar. Price reverses and does another strat combo. This happens to be a 2-1-2 down, and now it reverses to the downside. Your entry for the 2-1-2 down, this would be your entry, right? Entry, And where's your target? Would be the low of the candle right here. Look at the strat. You took your entry when it broke the low and you took it to the price target at 443.71. This is your inside bar breakout. Okay, now what are threes? This is a 3 candle. 3 candle is when it takes out the opposite or both sides of the range. You can see in this candle, and actually I think I can show it to you live so you can actually see how it works. You can see, boom, yep, perfect. This is, and that's why I love the backtest tool with strat. You can see, everyone, that this was at first a 2 candle, right? But look what happens. It goes 3. I'm gonna do that. I'm gonna replay that for you again. We're gonna play that. Right now, we have a bullish 2 potential setting up for a 2-2 reversal to the upside. We get that 2-2 reversal to the upside. It triggers, but it does not get to target. Because remember, this is your entry. This is your target right here. Price target. But it did not get to target. Remember how I tell you guys that strat is not 100%. You should not assume that if you're taking an actionable signal, it will get to target. The strat, all the strat does is tell you, what did we say before? It tells you probable outcomes, right? It turns possible outcomes into probable outcomes. And that is why we like the strat. We're saying that based off this 2-2 reversal, the probability of you getting to target is higher. But then when it doesn't, what do? You play what you know to be true. We see that you put in a failed 2-up candle. And for those of you that ask, what's a failed 2-up candle? A failed 2-up candle is a 2-up candle that does not get to its target. Okay? Because the strat tells you, based off this actionable signal or the strat combo, based off the 2-2 rev, the target is supposed to get to here. If it does not get there, and it reverses, that becomes a failed 2-up candle. We play what we know to be true. It is empirical in nature. So if it doesn't get there, we're like, we don't say, maybe I think it's gonna. No, we know right now it is a failed 2-up candle because it didn't get a target. If it's still live, we're gonna say it's a failed 2-up candle until it gets a target. And then what happens? This failed 2-up candle, remember with the outside bar, it has to go 2 up in one direction before going the opposite direction. And then it goes 3 down. Okay? So these are the 1s, 2s, and 3s of price action. Now, let's talk about broadening formations. And I see that someone had a question about broadening formations, and I'm just going to be drawing it right here. So if let me show you how to draw broadening formations. So remember how I told you that price moves from price moves from left to right, but also when you're looking at a chart, you want to look at a chart from left to right. I'll say it again, from left to right. So when we create broadening formations are created from a high to a higher high. So on the left would be a high, but on the right would be a high that's higher than the one on the left. Same thing with the low. You're going to draw it from a low to a lower low. Okay, so the low, and then to the right of it is going to be a low that's lower than that. This is a broadening formation. If we take this low and we take it to a lower low, that is your broadening formation. Okay? If we take a high and we take it to another high or a higher high, this is your broadening formation. Okay? This is the range that SPY is trading in right now on the 5-day chart. We say that this is your range. Broadening formation lows, broadening formation highs. And when we talk about magnitude, we say that the magnitude for SPY is up here. So depending on if you're bullish or bearish or whatever, the magnitude is essential. Oh, and this is not, I think. Okay. Boom. Okay. Beautiful. So we say that the magnitude for SPY is essentially up here. Now, I want you to look at this. Look at how we created a broadening formation and look at what happened. Look how price came down into that broadening formation. Wait, what happened? But I thought price was supposed to bounce. Remember, we talk about how price broadens over time. This is why broadening formations is essential. And this is why it's very, very imperative that you draw broadening formations, that you know that they exist. Because when you see that this is your broadening formation here, what happens? SPY breaks through the broadening formation and it creates a lower low. The price of the broadening formation, price broadens. So you can extend your broadening formation. Now you created your range, this is now your new range for SPY. And what happens when price hits a new low, right? They bounce to go up to create a high. Within this range, within all of this range right here, you have multiple broadening formations. You have this right here. You have this right here. You have this high connected to this high right there. You have this high connected, right there. You have this high connected to this high right here. All of these are broadening formations. All of them are broadening formations. Not SPY. Everything, price moves in a series of higher highs and lower lows. This is how price moves. If we look at NVIDIA, we can see that NVIDIA, what did it do? It expanded the broadening formation. The original broadening formation was here. Not original, but one of the broadening formations. And what did NVIDIA do? It broke through the broadening formation and price broadened. Hold on, I don't even think you see the watermark. NVIDIA. Okay? Price broaden, meaning that you extend. This is the new range. That is how things are essential, or not how, but things hitting all-time highs, right? You expanding the broadening formation. And what this is that is a this is that range on the hour. See? This is that range on the hourly. Okay? Now, on to the next one. The strat combos. And I'm also going to do this in conjunction with price action is fractal. And the example that I'm going to use for this one is the NVIDIA example. If you look at NVIDIA, and this is my favorite example to use all of 2023, NVIDIA 6-minute chart. If you look at NVIDIA on the 6-minute chart, the reason why I say that price action is fractal for this reason. For those of you that know about the 2-2 reversal, let me show you what the 2-2 reversal says. 2-2 reversal. Okay. This is a 2-2 reversal. Look at what NVIDIA did 2023. Shout out to the Money Printer Sal. Shout out to Eddie for being able to catch this. Look what NVIDIA did last year. What happened was, and this is why I say, this is why I love swinging. Because we know an action will signal if price breaks the high, you should take price to the next target. Look at what happened with NVIDIA. We start inside. Remember, we're only consolidating. Then look what happens. We break 2 up. We go 2 up. We now trigger the 2-2 bullish reversal. Now, price is supposed to go according to the strat to that price target. Look at what happens. Keep using your tool. Down. And I want you guys to pay attention to how it goes up and down. It doesn't just go straight up to the target. It goes up and down, indicating what? TTOs. When you go down, but notice how the trend naturally still is going up. Despite all the down candles it has, NVIDIA naturally will, or does, get to the target. 2-2 rev to the target. Now, if you look at NVIDIA on the daily, you can literally see back in 2023, the TTOs that occurred. Every red candle was used to make a new high. So I want you to think of it. If you saw a red day, remember, y'all traded NVIDIA in 2023. Whenever you saw a red day, that red day was a TTO for price to go higher. Any red day that you saw for NVIDIA last year was a dip buy for price to go higher. Any red day you could add in, you would have been higher end, or you would have been at a better average right now, or a better price right now if you would have got shares or something like that. If you were to use this tool, the drawing tool, you will see literally theirs was TTOs the entire trend up for NVIDIA. Boom, boom. Look how many times price has to come down. But notice that price comes down, but it never breaks trend. You are still putting in a higher highs and higher lows for NVIDIA. Continue this. And look, all the way to where we are today. NVIDIA all last year to this point has been TTOing. And that's why if you were to look at the, when I tell people, because it was even before Sal know, everybody know, we was calling 307, we was saying 307 NVIDIA like way before, like when NVIDIA was at 250. But the reason why we were saying it was because price said that is the target. And when NVIDIA, I'm sorry, if NVIDIA is showing you this candle right here, like this, and you were to look at it on the 6 month, and I were to ask you, hey, based off this candle on the 6 month, would you be a buyer or a seller? Okay, the only difference for this 2-2 reversal is that this 2-2 reversal took what? Took 4 months or something like that for NVIDIA to get to 307, compared to if you were to take a 2-2 reversal on a lower time frame, it would take, let's say if you're taking 15 minutes, it could take up to 15 minutes. So that's what we talk about when we talk about the price action is fractal. That any actionable signal you see on a lower time frame is the same as a higher time frame. It's just gonna take it longer to get there. Okay? Hopefully that makes sense. Now, let me go on to, before I continue, I know we got a couple of questions, so let me make sure we go on, let me answer some of these questions before I go on. Let me see. And I apologize if I know a lot of people, the chat has been going crazy. So if I miss your question, I sincerely apologize. Can we get examples for day traders? I know you kill the swing trades, but day trading is my preference. Yes, you can. And this is perfect. Price action is fractal. Let me give you an example for UPS. Because we took this trade the other day. UPS. So you go to 15 minutes. What was it? Monday. Okay. There we go. Okay. So UPS was a trade that I took back on Monday. And the reason why I took the trade was based off an actionable signal on a lower time frame. So remember how I'd say price action is fractal. For those of you that have watched my most powerful actionable signal and trading video where I talk about the 1-3 setup, and I'm glad some people had a question in that video where they talked about, okay, we see it for the swings, but what about the day trade, right? Same thing. With UPS on the 30, we know, and for those of you that watch the video, the 1-3 is a very powerful setup. It's a one-bar ref strat. ICT folks could say it's a power of 3. So many things that you can call it, right? Nirvana pattern as well. If you know how to trade the 1-3, or if you know the elements of the 1-3, you know that what it can do. So the 1-3 setup for UPS on the 30-minute is no different than the 1-3 setup from Costco on the 2-week chart, and I'll show you that, because you see that the 1-3-2, it does what it needs to do. Ever since the 1-3, you've been making a higher high. So this was our entry right here, right? And remember, this is the 30-minute time frame, and what you're doing is, let me show you right here. This on the 30 minute. If I go to UPS on the 65, I happen to use a 65-minute time frame. My apologies on that. $30 for the 4 hour. So my entry, remember, my entry was based off the 132 up on the 30-minute time frame. And remember how we talk about time frame we talk about participation groups, and we also talk about combinations. How the most probable trades are the ones when participation groups can trigger each other. So let me give you an example. When you are day trading, or when I'm day trading, everything is the same in terms of the elements of price action, but it's done on a lower time frame. Okay, so I have a 30 minute, 15, 65, and let's go. Okay, 15-minute time frame on UPS. What do we have? We don't have an actionable signal. There's nothing on the face. Well, I mean, some people call it 2-2 continuation actionable. I call continuation actionable signal, but we can talk about that later. But so you have a potential 2-2 continuation on the 15. For those that don't consider a continuation actionable signal, I won't say it is. So let's say it's not an actionable signal. But if you look at the 30, you have a 1-3 on the 30 with the potential to go 2 up. So remember how we talk about the relay race, right? If the 15-minute time frame triggers, if you get a new 15 at 8:30 and it triggers 2 up on the 15, that will trigger the 30-minute time frame to do the 1-3 2 up on the 30. If the 30-minute triggers the 1-3 2 up on the 30, which happens to be the same trigger as UPS on the 15, that makes the 65-minute do a potential 2-1-2 on the 65. Because look at the 65-minute. This 1-3 on the 30 was an inside candle on the. Let me do the hour for you guys, just so I can help. Yeah, let me do the hour. You guys are gonna say what, 65? So this 1-3 on the 30, if you combine these candles right here, that 1-3-30 made up this inside hammer. This is why we look at things on multiple time frames. That 1-3-30 made up this inside hammer. Now look at this, y'all. 1-3 is a actionable signal. Combine that with the potential 2-1-2 up on the 1 hour. When you see a hammer, and it's not just a regular 2-1-2 reversal, you also have a hammer as well. We know there's an actionable signal, 2 actionable signals, the hammer and the inside bar. So we're looking for price to break either side. Once we see the inside bar on the hour, we are saying that price can possibly lead to expansion on one side. Given the fact that we close relatively near the high of the hammer, and it's a hammer, we know that buying pressure was here. The upside is more probable than the downside. Not only that, you have an actionable signal on the 30 also telling you if this were to trigger, it can go there. If you look at the 2 hour, what does that make the 2 hour look like? That will make the 2 hour candle go up, and if the 2 hour closes, you're setting up for a potential or a possible 1-2-2 reversal to the upside on the 2 hour. So I want you to look at this. If you were to look at this lines, this is the entry for the hour, right? Which also happens to be the entry for the 30-minute and the 2-2 up 15-minute, right? And if price does break the 2-1-2 up on the hour and get to the target, which happens to be this candle right here. I hope people are still listening with me so far. Hope I didn't lose anyone, because we know based off this actionable signal, Strat tells us that based off the 2-1-2, you are supposed to take price to this candle right here. And if for those of you that don't believe me, show you real quick. This is the 2-1-2. Boom, boom, boom. 2-1-2. This is not bullish continuation, but you guys get the deal, right? So 2-1-2, get to target. 2-1-2, get to target. This is the target. Same thing as a picture. If that gets to target, what does that make the 2 hour look like? That would make the 2 hour do a potential 1-2-2 reversal to the upside. A 1-2-2 reversal is also an actionable signal of the strat as well. You guys don't believe me? I'll show you with this. 1-2-2 reversal right here. 1, 2 down, 2 up reversal. So notice, so let me take a step back. Y'all remember how it started off with the 30-minute? We had an actionable signal on the 30 that said if this actionable signal triggers on the 30, you have potential to trigger the 2-1-2 reversal on the hour. If the 2-1-2 reversal on the hour gets to the target, that will trigger the 1-2-2 reversal on the 2 hour. And that is exactly when we talked about the combinations, the different participation groups triggering each other. That is what leads to the most explosive type of plays. Okay, so does that answer your question about the lower time frame? Does that answer your question about the lower time frame actionable signals? Let me make sure that does. If you're a day trader, can you use the 15-30 1 hour a day? Yes, you can. Yes, you can. Yes, you can. Good. I'm glad. Okay, now on to the next question. Let's see. What other questions do we got? Can we get examples of uncoupling? Yes, let me show you what uncoupling is. All right, so let's go with uncoupling. So perfect. Now, need to beautiful. This works. Okay. AAL. So, AAL. Monday, January 8th, we had a green day. Okay. If I were to go. So on the daily, you see that we have a green day and price closes at 1467. Okay. So if anyone would look at this chart, they would say green buyers are here. If you were to look at the weekly, you would say the same thing, that we're green on the week. Remember, on a Monday, the daily time frame and the weekly time frame are going to be the same as each other because the daily and the weekly haven't uncoupled. The weekly and the daily are going to be the same as each other. It won't be until Tuesday where you can get uncoupling to occur. Now, let me go back to the daily for you guys so I can show you. Look at the daily. No, go back. So now look at the next day. The next day for AAL, we get a red day. Look, and if for those of you that have the trading view indicator, you see now AAL. If you were to look at AAL today, and you were to look at it today, you would say we are red on the day, that they are selling today, right? But if you were to look at AAL on the weekly, we are green. So what happened? What's the difference between Monday and Tuesday? The day uncoupled with the weekly time frame on Tuesday, because now the daily candle on Tuesday has the ability to show a different day or a different color from the weekly candle. The weekly candle can still be green. And why is the weekly candle green? Because price is still above the open of the weekly open. Price opened the week at 1403. That is the day that is the price that we opened the week of January 8th. We opened it at 1403. On Tuesday, price is still above 1403. So since price is still above 1403, the week will be green because we're still in this weekly candle. But the day is red because we are red on the day. So that's an example of uncoupling where you can't have uncoupling until the second hour on a Tuesday because that's when the 60-minute candle uncouples with the daily candle. That is when the daily candle has the ability to uncouple with the weekly candle. And then the next week, the following week is when the week can finally uncouple with the month. So really, I'm not going to go into details, but really this month that we're in, we may not even see true trend until next month because that's when the month can uncouple with the quarter, right? It's not until the end of this quarter until we can uncouple with the year. But that's going into too much deep. I don't want to get you guys confused, but that's uncoupling. It is not until the Tuesday where you can actually get a different you can get different time periods opening up irrespective of each other, and that's how you uncouple. Hopefully that answers that question. Can you go to particular high probability trade? Okay, what time frame do you manage the trade when intraday trading is small? So or when you're trying to keep the trot. So I have a saying that the time frame used to take the trade should be the reason why, or the reason why you enter the trade should be the reason why you exit the trade. So if you're entering the trade based off of a 15-minute actionable signal, you should have a 15-minute reversal that tells you that you should exit the trade. That's why for those people that, let's go to the week, 1 week, let's go to a weekly candle. Nah, that's not a good example. Maybe UPN. It's Wednesday, so is there a good example? What's the price that went up when? Okay, yeah, UPS. UPS is fine. So now, remember, this is also the same for lower time frame. So I'm sorry that I'm talking about the daily candle, but I hope you understand this in terms of lower time frame too. So if we took UPS, I took UPS based off this 132 up on the day. Remember, my favorite actionable signal is the daily chart. Right? Oh, sorry, not the daily chart, the 1-3. One of my favorite actionable signals is the 1-3. Unless, and I'm glad you asked this question because this answers a lot of questions in terms of like the entries for strat. A lot of people were taught that your entry should be your exit. So what we mean, or what you heard, is that if price breaks 149.46, your actionable signal, you enter. And if price goes below 159.46, you exit. That is not the case. That is not the case. The reason why is because if you take this trade based off the 1-3 setup on the day, you need this 1-3 setup to get invalidated on that same time frame. So what invalidates this 1-3-2 up? If price goes 2 down. Price would literally need to come 2 down before we consider getting out of the trade, because that's what actually will invalidate the setup. Of course, if you don't wick and then reverse and no like sell side liquidity and reverse back up, but that is what invalidates the trade setup. So I want people to realize, especially if you trade options, when price breaks your entry level and it now retraces, don't get out. Because if you took the trade based off the 2-1-2, based off that 2-1-2 break, it could still complete its target. All it may be doing is retracing, and then later it goes up to fill the target. How many times have you guys been in a trade where it triggers in the first 5 minutes and then later on in the day it does what it needs to do? Because people are getting out just because the literal price, the 159.46 price, is now coming back below and they get out. No, it needs to invalidate your thesis. So it literally needs to invalidate the thesis of the 1-3-2 up on the day by going outside day to the upside, 3-2-2 reversal to the downside. That is when it will actually reverse the thesis. So this should answer your question in terms of the lower time frame. If you are taking a trade based off the 15-minute, it should invalidate the 15-minute time frame before you should consider getting out. So if something triggers 2 up and it does not go outside bar, or it doesn't close below 50% of that bar that you used to take it, don't consider getting out, because if anything, remember, it went 2 up. Price went up. A higher high was established by price going up. That is a definition of an uptrend. So hopefully that answers your question with the what time frame do you manage. It's the time frame that is my thesis off of. So if I see an actual signal on the 1, you're using the 1 minute as your thesis. If your thesis is based on the 15 has to be the reason why you invalidate. Okay? Show the example of a coupling. Let me see. Can you draw a BF on a smaller time frame? Let me draw a BF on a smaller time frame. This is a 5-minute chart. Let me show you real quick. Boom. This is on a 5-minute time frame. And let me do this here. Let me draw. Now, this is so crazy, and this is why I love this. I'm sorry if I sound so shocked and stuff, I apologize. This is why I love this. This is why we love broadening formations, y'all. I drew this broadening formation from this point to this point right here. Literally, y'all see it, you guys see it. The point is from here to here. And you know what? Actually, nah. Let me show you just in case you know you don't. Let me show you. I'm not even gonna extend it. Look. This is where the broadening formation, just from this high to a higher high. Now watch this. I'm going to extend price to the right. Watch what happens. Tap, come down. Tap, come down. Tap, come down. This broadening formation was drawn on Monday the 8th. It tapped it on Wednesday today. Imagine, and this is why I love this, off a 5-minute BF. A 5-minute BF. And price ranged, got to the top of the range, came down. That's why broadening formations can be drawn on any time frame. And that's why my SPY chart looks like this. Because broadening formations, and this don't even look bad. You should see some other people. This is actually nothing. Trust me, this is nothing compared to what other strategies have. This is why we have all these broadening formations. We want to see the possible areas where price will hit a resistance or support and reverse trend. I don't know, for those of you, remember I called the Avgo trade. Oh, actually, this is gonna be kind of cool to show you guys. We took I mentioned an Avgo trade earlier today, and the reason why, and I even mentioned, like, here, I'm gonna show you guys. Let me show you. Avgo. Ooh, copy. So I mentioned, and actually, Avgo. Broadening formations. Oh, I still have it. So I mentioned in the chat, in the room today, watch Avgo. Cons are expensive, so not gonna alert a specific con, but look at the chart and tell me what you see. Based off of this picture right here. You're gonna get to a point where you know this is a bottom of the broadening formation. And I specifically didn't want to draw the line because I wanted members to, because we preach homework out here. I wanted them to look at the chart and do it for themselves. If you drew Avgo on the 15-minute, or if you saw Avgo on the 15-minute time frame, it came down just to a broadening formation right here. Right? When price came down to a low, you see, we made a low right here. We made a low here and made it higher, but then you made another low right here, and now your price reversing up. Connect these lines, broadening formation on a 15-minute time frame to establish a range, and now you have a new trading range. And this is how it reacted. The broadening. See how broadening formations are powerful? So that's why when price comes down, we want to look at where price is wicking. Broadening formations can be drawn on any single time frame. On any single time frame. It can be a 1 minute, 2 minute, a 2.5 minute, a 37 minute, any time frame. You will see broadening formations everywhere. Okay. Let's look at other questions. Where do you set your target if you're at an all-time high, since there is no historical data? Okay, so I like to use fib extensions because you're now at price discovery. You need to understand that with all-time highs, you are at the risk of possible seller exhaustion whenever they want to come in, and broadening formation reversal. Because whenever you are hitting all-time highs, let me show you in the video right now. Beautiful, beautiful question. Go to the daily. And if we go to the daily, the original broadening formation was here, here. Okay. And you also have. Now, what happens now that NVIDIA broke this broadening formation to the high? Price broadened. So now we move the broadening formation up. That's the broadening formation, right? So, or if you really want to get advanced, you create a new broadening formation. That's the next step. You create a new broadening formation. Okay. But what are we at right now? NVIDIA is at risk of a possible broadening formation reversal. Now, we're not saying that will happen. I'm not saying that's going to happen at all. But you do have to understand that as you reach all-time highs and as you continue to break higher, you are facing possible broadening formation reversal or broadening formation exhaustion, because an all-time high is the higher high that's being created. Remember, yesterday you made a new high, so you could connect the line to this higher high. Today you made a new high. You connected the line to another higher high. That is why broadening, as NVIDIA goes up, it will always be at risk of broadening formation exhaustion risk. Not saying that it will do it, especially with full-time frame continuity, but you just need to understand that it exists. So that's why when you see a trade all of a sudden reverse on you, you're like, whoa, what happened? It was probably hitting a broadening formation. Okay. So that's how I would trade. I would use fib extensions. I'm not going to go into fib extensions right now, just in the interest of time, but I use fib extensions as well for looking at things at all time. Okay. Does it make sense to only draw broadening information on 3 bars when first learning? I'm asking because I know they are compound 2 bars. Great question. 3s can be drawn anywhere as long as a high is being connected to a higher high, a low is being connected to a lower low. So it doesn't matter if that. Look at this example. NVIDIA is a 2 up. But I connected a broadening formation here. This is not a 3. As long as a higher high is being connected, you're good to go. You can create a broadening formation. It does not only have to be on 3 bars. Let's see. Let me get under more likes. What question? Can we explain use sector rotation and how we can use it? Oh, now y'all really trying to get into, so that's part of the swing trading masterclass where we talk about, but of course, let's talk about sector rotation. So, and I won't try to get into too much detail, but sector rotation, the reason why I feel, or not feel, but like it's very, 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 very extremely helpful. One, because it helps with simultaneous breakouts. You can see that in sector rotation, and you can literally see when they're rotating between a different sector. So if we know institutions are the one that drive prices, they're the one that literally take price from and deliver price to where they needed to go. We know that they rotate between sectors. 1 quarter, 1 year, it could be oil, and they could rotate between oil and tech. Tech goes up 1 year and oil goes down, right? Or we can see seasonality also come in play with sector rotation. I always give the example about going into the 4th quarter with healthcare. Healthcare generally does well 4th quarter because think about fundamentally what's going on in the world, right? We have temperatures dropping, more people are getting cold, more people are getting sick, and it's just a time where pharmaceutical companies and just healthcare companies can make more profits in the 4th quarter. So that's another part of sector rotation, is also understanding seasonality as well. When we are at times of war, we know that commodities or oil or gold tend to go up because investors start to put their money to those names, right? Or defense tickers. If we know there's going to be a war going on, you're putting your money in your LMT, your RTXs, your NOCs, and things like that. So you can see literally rotation happening. And how do we what's a good way for us to see sector rotation is knowing what the spider sectors are. So I'm going to show you guys a resource, Sector Spider. Sector Spider is a sector tracker. You can see the 11 spider sectors of the S&P 500. You have XLC, XLY, XLP, XLE, XLF, XLV, XLI, XLB, XLRE, XLK, XLU. Communications, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, materials, real estate, technology, and utilities. And just like how the sectors or the ETFs also have charts as well, like let's give you the example of XLC. Same thing with stocks. So the actionable signals, I want you to think of it. The actionable signals that you see for stocks, if you think like, hey, this chart looks good for the upside based off this actionable signal, you can say the same thing for an ETF. If an ETF or the sector has an actionable signal to the upside, for example, XLC had a nice candle on the day right now. We saw what the Googles did. We saw what the Metas did. If you have an actionable signal on a particular sector, let's say a 212 up, we know that a simultaneous break can occur with the stocks within that sector. You should expect, or you'd want to anticipate, that if the sector or the ETF breaks higher, makes off an actionable signal, a 212 up, right? You should expect this corresponding stocks within the sector to do the same. So that's how we can get in trades early. That's how we're able to understand sector rotation a little bit early, because you should see these sectors setting up for a move. Let me just give you guys an example, like IGPT. IGPT is an AI and next gen software. And I keep telling people about AI going crazy. I mean, you guys already knew that, but AI going crazy. Why? I mean, look at the 6 month time frame. I mean, you got a hammer on the 6 month. You got a look at the 12 month chart. Like, look at the 12 month. Like, I don't want people to think about this. You have a 12 month chart. So 12 month chart tells you you have a potential 212 up on the 12 month chart, right? On the yearly. This is a yearly. So yearly participant. But we know that based off the 12 month chart, the strat tells us that if we break this 212 to the upside, the target is right there at $42.73. So now, if IGPT, which happens to be the Invesco ETF AI and next gen software. Sorry, I know I'm not looking at a sector right now. I'm looking at ETF. But then what do? I can go and look at the stocks within IGPT. Where is it? I know I got my IGPT. Where's my IGPT? Oh, do I not have IGPT? Oh, I guess I don't have IGPT. Ledger, a good example. Okay, Ledger's a good example. So Ledger is a good example where you're about to trigger a 312 up on the year. So what I would do is I would go to the corresponding sector and then our ETF, and I would see which holdings also have this potential same setup. Look at Ledger on the yearly, potential 312 on the year. And if I look at the holdings within this ETF, I can see you have AMD. Look, same thing, 212 on the year, right? Let's look at INTC, potential 212 on the year. Well, happens to be the same thing. Look at CRM. Oh, potential 22. This is 22, so it's kind of different. TSM. Oh, potential 312 on the year. Microsoft. This one is out of here. Shout out to those of you that take Microsoft. Amazon. Potential 22 rev on the year. Notice how and look at where the inside candles are on the year. They're all relatively near the high of that yearly breakout. So you can use the sector or the ETF to tell you where price is going to go. XLC right now triggered a 212 up on the yearly chart. Let's look at the Googles. Google, 312 up on the yearly chart. Let's look at the Metas. 2-2 continuation on the yearly chart. Netflix, almost a 212 on the yearly. So if XLC breaks 212 on the year, I think it did, 212 on the year already, what do I expect Netflix to possibly do if XLC is already showing the signs that it already did it. I expect Netflix to also trigger its 212 on the year to follow XLC. Okay. Hopefully that helps. All right. Hopefully that helps. Is the gap fill considered a pullback? I don't like to think of a gap fill as a pullback. I like to think of a gap fill as sorry if I get the phrase wrong, drawn liquidity, or just liquidity that price can gravitate towards too. I like to look at gaps as magnets, as an area that price wants to get to. All right, let's see. Oh, any other questions? I'm scrolling through here. Thank you for all the comments. Is there any other questions though? I don't want to make sure I miss any. Is there any other questions? I know we've been going on for about 3 hours now. I don't want to take too much of your time. It's about to be going to be 11 p.m. for those of you in the East Coast. I'm in the West Coast, so I'm sorry. I apologize. So, but is there any other questions? I don't. And before I go, like, I know one masterclass, one session is not gonna be not gonna be enough for you. Like, okay, now I understand the strat. Like I under that. It takes time. I'm in my 4th year of understanding the strat, of learning the strat, and I told my group even today. I told them today that as I was creating this presentation, there was things that I was still getting aha moments for in year 4 of trading. And so that's why I don't want people to think that you're going to get it today. It's a process. And when it comes to trading, especially those of you that are new, you have to understand that there is a process first when it comes to trading. And you have to trust and understand the process of trading before you want to attain the profits, okay? Process over profits every single time. All right, we got some more other questions. Do you have a way to scan for other undervalued options? Personally, I do not. I do not scan for undervalued options. Do you ever go down to like the 5 minute to find an entry when you are swinging and taking the actionable signal off the 30? So I don't find it. I don't go to the 5 minute, and I don't go to the 5 minute. The 15 minute is really like the lowest time frame that I will look at. The reason why is because you can have a lot of quote unquote, I'm not gonna say it because of YouTube, effery go on in the lower time frames where you can have a lot of fake outs and breakouts and stuff. And we know the higher time frame is when the highest time frames, that's when you're getting more statistical data, right? So like if you see the monthly chart, you know that is a month worth of data, rather than if you're just looking at the 5, that 5 minutes, just 5 minutes worth of data. And that 5 minutes worth of data can literally change, right? You know that the higher time frames have more magnitude or are more reflective of price rather than the lower time frames. So that's why I just always refer to the higher time. What strat indicator do you use to show the numbers? So the strat V2 Nagami by Nagami, or you can use the strat candle type by Crinklebind. Let me just show you right here. So the strat teach V2 by Nagami. Shout out to Nagami. Hope he's doing well. Missed that, man. And then candle type, the strat Crinklebind have that as well. Okay. Oh, you are welcome. You are welcome, Hunter. You are certainly welcome. Well, is there any other questions? I'm not really seeing any questions in the chat, man. I know this has been like I said, this has been a phenomenal class. I appreciate all of you guys for coming out, spending some time, taking some time out of your night to listen to me rant, to listen to me talk. Like I always say, I say I don't know anything. So the fact that you guys want to listen to me, it's really humbling. It's definitely a humbling experience. I thank you guys so much. Really, really appreciate it. And for those of you that are new, this is your new time watching some of my videos, feel free to follow me on all my social media accounts, on social media platforms. You can follow me at AdexTrades on Twitter, AdexTrades on Instagram, at AdexTrades on TikTok, AdexTrades on YouTube, which you guys are on right now. We're pretty much on every single social media platform. And this year, one of my goals this year is to just flood you guys with content, educational material that is going to help you. As you guys that follow me, you guys have seen the reels that I've been posting. I just want to give you guys as much content. I said this in the beginning. Rob made the strat, or he intended for the strat to be given for free. It is free. It is for everyone. So rightfully so, I will present this information to you for free because it's out there. And you guys, and for those of you that don't know me, you guys, I don't want to say I yell a lot, but I believe everyone can become a successful trader and a profitable trader as long as you put in the time, as long as you do the homework that's required. You can look at and I'm not even trying to toot my own horn, but just look at the testimonials in our Discord server. Look at the testimonials on our website. It's not me. I'm gonna make my money, but it's for you guys. We want to show you guys what's possible. We want to show you that you are able to make money in this market. We want you to not be that 90% of traders who fail. You won't. It's simple. You won't. As long as you put in the work, I promise you. You don't believe me? Ask people in this chat. And I'm not even trying to toot my own horn. Ask people in this chat. People have seen their confidence grow from last year, 2 years ago, 3 years ago, 4 years ago. I promise you, if you put the time and the effort, the patterns that you're going to see, the patterns that you're going to recognize, you're just going to start recognizing them more and more. And then at that point, once you start getting the foundation, the TA, then it's just risk management and emotions at that point. All right. So thank you all for coming to the Beginner's Guide to the Strat Masterclass. Again, you guys know where to find me. Find me on all social media platforms. If you want to learn more information, like I said, you can find it on YouTube. I have other videos as well. We do trade. We do trade every single day in our Discord. We live trade as well, going over examples, going over a trade, why we believe that these trades can be a winning trade or not. Ultimately, my goal as educator, I would like to say, I just like to say, because I like this, is for you to become a profitable and consistent trader and not to rely on anyone's call outs. That's my goal. And if you can do it, we've done our job. All right. So I appreciate every single one of you. You guys have a wonderful night. Don't forget, we got CPI in the morning. I know some of y'all ain't gonna sleep tonight, but other than that, you guys have a wonderful, wonderful night. And I will see you all tomorrow, and I'll see you all for the next presentation. Peace out, everyone. Have a good one.